Please like, share, and subscribe. Wishing you happiness and good luck every day.
You know, for the longest time, the only way to get the real wisdom from Warren Buffett and Charlie Munger was to actually be in the room with them in Omaha. No recordings, no broadcasts. But that's all changed. We now have this incredible treasure trove of over 30 years of their completely unscripted Q&A sessions. So what we're going to do here is something pretty ambitious. We are going to distill that mountain of insight into a real, actionable playbook, using their own words to get inside their heads and see how these two legends really think.
All right, so here's how we're going to break this down. We've organized their whole philosophy into 5 key parts. First up, the absolute foundation. What makes a great business? Then we'll get into their toolkit, which is, well, it's pretty different from what you might expect. After that, we'll talk about the mindset, because that's huge for them. We'll also cover the big blunders. Yep, they made them. And finally, we'll zoom out to see how they view the whole system of capitalism.
Okay, let's dive in with part 1, the foundation, finding those great businesses. And let's get one thing straight right at the start. For Buffett and Munger, this has never been about picking stocks. It's not about playing the market's wiggles and jiggles. The absolute bedrock of their entire philosophy is understanding the business. I mean, really understanding it, as if you were about to buy the whole thing and own it forever.
And this quote from Buffett just nails it. Think about it like this. A great business is like planting a healthy tree. Time is your best friend. It just grows and grows, compounding value all on its own. But a bad business? Man, that's like a leaky boat. Time is your mortal enemy. You're constantly bailing water, plugging holes, and pouring in more money just to keep it from sinking. Time just makes the problems worse.
This right here, this is the massive mindset shift you have to make to think like them. They're not just renting stocks, hoping for a quick pop. They are literally trying to buy into a business as if they're going to be a partner in it for the rest of their lives. And hey, if you're going to marry a business, you better do your homework, right? You need to know its history, its personality, and whether it's built to last through thick and thin.
So, what's the secret sauce? What actually makes a business great in their eyes? Well, it all comes down to what they famously call a moat, some kind of durable, long-lasting competitive advantage. And their favorite example lately? It's Apple. In fact, Buffett has said it's probably a better business than any of the companies Berkshire owns 100% of. Just think about that for a second. Why? It's all about its incredible connection with its customers. He has this great line. He says, someone might have a second car that costs, say, 35 grand. But if you told them they had to give up either that car or their iPhone, they're getting rid of the car. That, right there, is power. That's a real moat.
Okay, on to our second section. So you know what a great business looks like, but how do you actually find one? Well, this is where things get really interesting, because their toolkit, it's not what they teach you in business school. They basically throw out all the complicated stuff that Wall Street loves. In fact, a lot of what they do is the complete opposite of standard practice. And it starts with a little acronym you've probably heard 1,000 times.
Yep, EBITDA. You see it everywhere, right? The textbook definition says it's earnings before interest, taxes, depreciation, and amortization. The idea is that it's supposed to be a cleaner way to see how a company is performing, sort of a stand-in for cash flow. That's the official story anyway. And then you get Charlie Munger's take on it. Wow. He doesn't just think it's a bad metric, he basically thinks it's a sin. He finds the whole concept disgusting. For them, this isn't just some disagreement about accounting. They see it as fundamentally misleading, almost a moral issue.
So what's the big deal? Why do they hate it so much? It all boils down to that D. Depreciation. See, Wall Street loves to call depreciation a non-cash expense, something you can just add back to make earnings look better. Buffett and Munger say that is complete and utter nonsense. Depreciation is one of the most real expenses there is. Look, if you own a trucking company, you have to buy trucks, right? That's real cash going out the door. And guess what? Those trucks wear out. You're going to have to spend more real cash to replace them. That's what depreciation represents. Ignoring it is just a gimmick that Wall Street uses to make companies look healthier than they are, which, surprise, surprise, helps them sell deals and collect bigger fees. And this deep skepticism doesn't stop with EBITDA. It goes for financial projections too. You know, those fancy spreadsheets that predict earnings out to 5 or 10 years. Buffett says he and Charlie have never used one when deciding to buy a business. And this quote is just perfect. Don't ask the barber whether you need a haircut. Of course, the investment banker is going to show you a projection where everything goes up and to the right. They're trying to sell you something. To Buffett, those projections are just sales documents, not serious analysis. He calls it total nonsense, and he is not kidding.
All right, so this brings us to a really crucial part of the playbook.
We've talked about what to look for and what tools not to use, but maybe the most important piece is the mindset. It's not about being the smartest person in the room. It's about having the right temperament, the right psychology, and building the right kind of environment around you. And at the core of that mindset is one simple word: trust. I mean, look at this quote from Munger. It's so profound. He has this great point where he says, "Isn't it funny how the companies with these massive 100-page compliance manuals and huge legal departments seem to be the ones that are always in trouble?" Their philosophy is the exact opposite. You do the hard work up front, find people you can genuinely trust, then you get out of their way and let them do their job.
And this isn't just talk. They've actually built their company around this idea. I mean, think about this. Berkshire Hathaway is a company worth hundreds of billions of dollars, and they don't even have a consolidated monthly P&L statement. There's no one at headquarters telling the CEO of, say, See's Candies how to run their HR department. They call it a culture of minimum bureaucracy, and the reason is simple. It lets their managers actually focus on running the business, and it creates a genuine passion for the work that you just can't get when you're buried under corporate red tape.
So you might be asking, well, if headquarters isn't doing all that stuff, what is their job? For Buffett and Munger, it boils down to one of the most important jobs of any CEO: capital allocation. That means deciding where the company's profits should go. And they believe it is a massive, terrible mistake for a CEO to hand that job off to someone else. It's their #1 responsibility, and they handle every major decision themselves.
And this is just a classic Mungerism that sums up everything they're trying to avoid. Your employees retire, but they don't tell you. He's talking about that deadening effect of bureaucracy. It's when people are so bogged down by rules and procedures that they just check out. They're physically there, but their mind, their creativity, their passion, that's long gone. And that's a huge loss for any company.
Okay, section 4. Now, it would be really easy to listen to all this and think these guys are just infallible, right? That they just came up with this perfect playbook from day one. But that is not the case at all. The truth is, this whole philosophy was forged through making mistakes. Big, expensive, painful mistakes. And they're incredibly open about them because that's how they learned.
Let's talk about the big one, Dexter shoe. Buffett himself calls it one of his worst mistakes ever. So he buys this shoe company, right? He thinks it has a great moat. And to make it worse, he doesn't pay with cash. He pays with Berkshire Hathaway stock. The first problem was the business itself. Its moat, which was based on making shoes in the US, turned out to be a sandcastle. It got totally wiped out by cheaper foreign competition. But the second part of the mistake was even more painful. The Berkshire stock he used to buy this worthless company became astronomically valuable. So they lost billions. The lesson was absolutely seared into their minds. A moat isn't a moat unless it's durable and can withstand the big, changing tides of the global economy.
And I love this quote from Charlie because it shows their mindset even today. It's the ultimate humility. After all these decades of success, they're not arrogant about it. They know they're human. They know they'll get things wrong again. For them, making mistakes and learning from them isn't something you outgrow. It's just part of the game, forever.
All right, for our last section, let's zoom all the way out. Because this isn't just about how to invest. Their ideas connect to a much bigger picture, a whole philosophy on how capitalism works and how it should work. They aren't just participants in the system. They're really thoughtful students of it, and they're very clear-eyed about its good sides and its bad sides.
So on the one hand, Buffett is a huge fan of the market system. He calls it marvelous for a reason. It creates incredible wealth and innovation. But he doesn't have these rose-colored glasses on. He knows that the very same process that creates all that good stuff, creative destruction, is, and I'm using his words here, a very brutal game for the people who get left behind.
But here's the other side of that same coin. That brutal process is also the reason we have the standard of living we do. Productivity, figuring out how to get more stuff with less effort, is the engine that makes life better for everyone over time. It's why we can be confident our kids will live better than we do. So you see the dilemma, right? The very thing that causes painful disruption is also the thing that creates widespread prosperity. You can't have one without the other.
So what's the answer? How do you deal with that paradox? For them, it comes down to balance. Their view is you let the engine of capitalism run because it's what makes the pie bigger for everybody. But, and this is a huge but, you have to acknowledge that a society as wealthy as ours has a duty, a responsibility to take care of the people who get run over by that engine through no fault of their own. And so, that really brings everything together. When you look at the whole playbook, from how they pick businesses to how they think about the world, it all comes down to one thing: playing the long game. And that leaves us with, I think, the most important question of all. We live in a world that is obsessed with speed, with what's happening now.
So how can you, and how can I, cultivate the kind of patience it takes to actually win a game that's measured in decades, not days?
All right, let's get into it. Today, we're cracking open the playbook of two of the absolute masters of the investing world, Warren Buffett and Charlie Munger. We're going to try and distill decades of their wisdom down into something clear, something we can actually use. This isn't about the frantic day-to-day noise of the market. Nope, this is about getting back to the fundamental principles that really work. And I think this quote from Charlie Munger is the perfect place to start because it really gets to the heart of their whole philosophy. You see, for them, success was never just about picking stocks or crunching numbers. It was rooted in this deep, relentless curiosity, this need to understand how the world really works. That way of thinking, that's the bedrock for everything else we're going to talk about. Okay, so here's our roadmap for today. First, we'll tackle what value investing really is and what it isn't. Then, we'll look at their surprisingly straightforward way of finding incredible businesses. After that, we'll dig into the magic of compounding, talk about why your own brain can be your worst enemy in this game, and finally, look at their simple, and I mean simple, strategy of buying, holding, and, well, almost never selling. All right, first things first, we have got to clear up a huge misunderstanding. I'd say it's probably the biggest myth in all of finance, honestly. It's this idea that there are two warring factions in the world of investing. You know the drill. You hear it on TV all the time. They pit value investing against growth investing. The story goes that value is all about buying boring, statistically cheap companies, maybe ones that are a little beat up. And growth? Well, that's the sexy, fast-moving, expensive-looking tech companies. They're always presented as complete opposites, right? Well, Buffett just blows that whole idea right out of the water. He's always been puzzled by this because for him, it's not a competition. It's just math. Growth isn't the opposite of value. It's a piece of the value puzzle. I mean, think about it. A company's ability to grow in the future is a massive part of what it's actually worth today. So here is the big takeaway. For Buffett and Munger, every single investment decision comes down to one simple question. Just one. Am I paying less for this business today than all the cash it's going to spit out over its entire lifetime? That's it. That is the whole game. It doesn't matter if it's a railroad or a software company. The question never, ever changes. Okay, so we've got the core philosophy down. Now, how do you actually do it? How do they turn that idea into a practical way of finding these great investments? What you're about to see is that it's not about being a genius. It's about looking for the easy wins. I love this quote from Buffett. He's basically saying, why try to be a high jump champion when you can just step over a 1-foot bar? Their whole strategy isn't about solving these incredibly complex puzzles. It's about having the patience to wait for the no-brainers, the obvious opportunities that, believe it or not, most people just walk right past because they're looking for something more complicated. And this is how they put that 1-foot bar idea into practice. It's a simple but incredibly powerful 4-part filter. Think of it like a checklist. First, do I actually understand this business inside and out? If the answer is no, you're done. Move on. Second, does it have a real, lasting advantage over its competitors? No? Next. Third, can I trust the people running the show? Are they both smart and honest? And only if you get a yes on all 3 of those, do you even begin to think about the price. This simple process eliminates almost everything out there. And that gets to the absolute core of it, doesn't it? The main goal isn't to be brilliant. It's to not be stupid. It is all about avoiding the big, obvious mistakes. If you can just manage to sidestep the major blunders, you are already way ahead of the game. So much of winning is just about not losing. Okay, so let's say a business actually makes it through those 4 filters. What's next? Well, now they're on the hunt for something very specific. One special quality that acts like rocket fuel for building wealth over the long haul. This right here, this is one of my favorite lines. It says it all, really. If you own a mediocre, crummy business, every day that goes by is just another day for it to fall apart and lose you money. But if you own a truly great business, time becomes the best friend you could ever ask for. It does all the heavy lifting for you. So, what does one of these great businesses actually look like? Well, Buffett has a name for it, a compounding machine. Picture this. It's a business that's already making a ton of money on the capital it has. But the real magic is that it can take all those profits and reinvest them back into the business to earn those same fantastic returns, year after year after year. Okay, let's just run some simple numbers to see exactly how powerful this really is. Imagine you find one of these compounding machines and you invest 10,000 bucks. Just 10 grand to start. Now, let's say this business earns a solid 20% return on that capital. After year 1, your 10 grand is now 12,000. Pretty good, right? But here's the kicker. For next year, you're not starting with 10,000 anymore. You're starting with 12. So in year 2, that same 20% return is on a bigger number, which gets you to 14,400. You see what's happening? Your money is starting to make its own money. That's the famous snowball effect Buffett always talks about. As it rolls down the hill, it just gets bigger and moves faster, all on its own. So the math is simple. The filters make a ton of sense. The power of compounding is, well, it's magical. So why isn't everybody doing this? Why aren't we all billionaires? Well, that brings us to the hardest part of the entire playbook, the part that happens right between your own two ears. Buffett and Munger will tell you straight up that you do not need a 160 IQ to be a great investor. In fact, they'd argue that sometimes being super smart can actually get you into trouble. What you really need, the one thing that separates the winners from the losers, is emotional control. Yeah, the real battle isn't with the market. It's with yourself. It's about taming those two powerful, hardwired human emotions, fear and greed. They're what cause most people to make irrational decisions, to panic and sell when things look terrible, and get euphoric and buy when everything is at an all-time high. Your job is to be the calm one in the room and do the exact opposite. So it's not about being a math whiz, it's about building a certain kind of character. You have to be emotionally stable, just steady as a rock when the markets are going haywire. You've got to have incredible patience, the ability to just sit there and do absolutely nothing for long stretches of time. You need humility, the guts to admit, I don't know, and to stay away from things you don't understand. And maybe most of all, you need to be able to think for yourself and not just follow the herd off a cliff. All right, we're at the last piece of the puzzle, the end game. And I've got to say, in our modern world of nonstop trading and constant phone notifications, this part of their playbook might be the most radical idea of them all. What's their big default action? It's inaction. It's doing nothing. Seriously. Once they've done all the hard work to find one of those amazing businesses and buy it at a sensible price, they figure the job is pretty much done. Their favorite holding period, as they've famously said, is forever. You just buy it, sit back, and let that compounding machine do its work. And really, this brings us full circle, back to that first Munger quote. It all ties back to this philosophy of being a lifelong learner. Investing isn't a one-time event. It's a continuous process. It's about trying to get a little bit smarter every single day, patiently building your wisdom, decision by decision, over an entire lifetime. So there you have it, the philosophy, the filters, the mindset. The playbook itself, it's actually pretty simple, isn't it? But following it day in and day out, year after year, especially when everyone around you is losing their minds, now that is the hard part. The playbook is in your hands, but the real question is, do you have the discipline to actually use it? So how do Warren Buffett and Charlie Munger, arguably the greatest investment duo in history, how do they figure out what a business is really worth? It's the billion-dollar question, right? And the answer, believe it or not, is completely counterintuitive. They're not using some complex algorithm or these giant sprawling spreadsheets. No, their entire philosophy, the very engine behind Berkshire Hathaway, it all boils down to a single piece of wisdom from over 2,600 years ago. That's it. A simple line from one of Aesop's fables. And you're probably thinking, okay, what on earth does an old fable have to do with modern finance? Well, as it turns out, everything. For them, this isn't just some quaint little saying. This is the bedrock, the absolute foundational key to how they think about every single investment they make. Because what Buffett and Munger did, and this is the genius of it, is they took this incredibly simple idea and unlocked the profound financial truths that were hidden right inside it. So today, we're going to deconstruct exactly how they turn this ancient fable into a practical, powerful tool for valuing pretty much any business. Okay, let's dive in. So here's our game plan. We're going to start with that foundational lesson from Aesop. Then we'll get into the great myth of growth versus value and why they think it's nonsense. We're going to explore why they absolutely despise the very spreadsheets that Wall Street lives and dies by, and what they use as their true measure of value instead. We'll also cover their single most important filter for any new idea, and we'll wrap it all up with what Munger so colorfully calls the sit-on-your-ass approach to investing. So let's start right there with that 2,600-year-old piece of advice. Buffett absolutely loves this quote. He calls it the first investment primer ever written. But he also says that old Aesop, as smart as he was, kind of left the job half-finished. He missed something really, really critical. The core idea is simple enough, right? The cash you have in your pocket today, that's your bird in the hand. And you can invest it to get more cash later. Those are your two birds in the bush. The whole game of investing is just deciding if that trade-off is worth it. But, and this is the key, to make that decision intelligently, Buffett says you have to ask two more questions that Aesop just never got around to. And here they are. First, when are you going to get those two birds from the bush? Is it next year? Or is it 20 years from now? You see, the timing changes everything. A promise of $1 in 1 year is worth way, way more than a promise of $1 3 decades from now. And second, what are the interest rates? This is your yardstick. This is what you compare everything against. I mean, if you can get a guaranteed 5% from a government bond, your investment in that bush had better offer something a whole lot better. These two simple questions, they transform a folksy old saying into the universal formula for valuation. Now, once you understand that framework, it leads us right to one of the biggest myths in all of investing. It's this false choice that Buffett and Munger have spent decades trying to tear down. This idea that growth and value are somehow two separate opposing strategies. For them, it's just a totally artificial distinction. I mean, as Buffett puts it so plainly here, they are not two different styles of investing. Growth is simply one component of the value equation. So the real question isn't, is this a growth stock or a value stock? The only question is, how much value does its growth actually create? And this slide, it just lays out the two mindsets perfectly. You know, Wall Street loves to put companies in these neat little boxes. This is a growth stock, that one's a value stock. Berkshire? They just ignore the labels completely. They're only looking at the underlying business economics. For example, is the growth actually profitable? Does it suck up tons and tons of new cash for just a tiny little return, like the airline industry often does? Or does it just gush cash with very little new investment, like their famous purchase of See's Candies? That's the only distinction that matters. Period. Okay, so if they're constantly thinking about the value of future cash, you would assume they have these incredibly detailed financial models and spreadsheets running all the time, wouldn't you? Well, you'd be wrong. In fact, they have this deep, almost comical aversion to them. I just love this quote from Munger. It reveals so much with such a dry wit, you know? It perfectly captures their whole approach. They absolutely believe in the theory of discounted cash flows. That's the whole bird in the bush idea we've been talking about. But they never actually sit down and write it out. There's no calculator, no software. If the answer isn't obvious enough to do in your head, they're just not interested. And this explains why. Buffett's logic is that an investment should be so compelling, so obviously a bargain, that you don't need a spreadsheet to prove it to yourself. If you're sharpening your pencil and fiddling with decimal points to try and make the numbers work, well, the margin of safety is just way too thin. The opportunity has to be obvious. It has to practically scream at you. Munger, of course, takes it a step further with his profound distrust of formal projections, especially when they come from someone who's trying to sell you something, like an investment banker. He compares them to a lie, not always a malicious one, but a lie that's born from subconscious bias and a whole lot of wishful thinking. They just don't trust precise forecasts, and they don't want to be swayed by their false precision. So, if they throw out the spreadsheets and they ignore the projections from management, what are they actually doing in their heads? What is the true yardstick that they're using to measure a business's worth? It all comes down to this single concept, intrinsic value. And the definition is just beautifully simple. It's the total amount of cash a business can give to its owners from today until the day it closes its doors for good, all discounted back to what that whole pile of cash is worth today. That's the number. That is what they're trying to estimate in their heads. So the crucial thing is how they do this mentally. First, they think of a business like a bond that has coupons. They try to estimate what those future cash coupons are going to look like. Second, and this is probably the most important step, they assess how certain they are about those coupons. Can they really, with high confidence, predict the cash flow of this business for the next 10, 20, 30 years? If the answer is no, it immediately goes into what they call the too hard pile. Third, they use a really simple common sense discount rate, the interest rate on long-term government bonds. It's their basic risk-free measuring stick. And finally, they demand a huge margin of safety between their conservative estimate of value and whatever the market price is. It has to be a clear, obvious bargain. Okay, now, even if an idea passes that whole mental calculation, they run it through one more filter, something Munger considers one of the most powerful yet simple ideas in all of investing. It's the concept of opportunity cost. And Munger's logic here is it's brilliant in its simplicity. Why would you waste your precious time and energy analyzing hundreds of mediocre ideas when you already own a truly great one? You should compare every new potential investment against the very best opportunity you already have. And if the new idea isn't clearly better, you just say no and move on. It's an incredibly efficient way to think. And they apply this in a super practical way. When somebody brings them a business to consider, the first question they ask themselves is something just like this. Is this a better place to put our money than just buying more shares of Coca-Cola or See's Candies or some other business we already know and love? That simple question screens out almost everything that ever comes across their desks. So this entire process, the focus on certainty, that incredibly high bar set by opportunity cost, it all leads to the final and, for a lot of people, the most difficult part of their whole strategy. After all of this intense mental work to find a great business at a fair price, what you do next? Munger, in his uniquely blunt way, just says it all right here. The goal isn't to be an active trader, constantly jumping in and out based on market noise. The real skill is finding a few truly wonderful companies and then having the discipline, the temperament to do pretty much nothing, to just sit and let them compound their value over decades. And Buffett echoes the exact same idea. Finding a genuinely great business is incredibly rare. So when you are lucky enough to find one, your job isn't to try and time the market or sell when the price seems a little high. No, your job is to simply hold on. Inaction, in this case, becomes the most profitable action you can take. And that really brings us right to the heart of it all, doesn't it? After you strip away all the jargon and the complexity, maybe the true secret of Buffett and Munger isn't some hidden analytical genius that nobody else has. Maybe it's a mindset, a clear framework built on an ancient fable, a deep skepticism of forecasts, and at the end of the day, just a profound and unshakable patience. Something to think about.
All right. Today we are digging into the minds of two absolute legends, Warren Buffett and Charlie Munger. We're going to unpack their playbook for one of the toughest jobs in business, a job that trips up even the smartest leaders out there, figuring out what a company should do with its cash. And this quote from Warren Buffett just nails the problem perfectly. You see, a leader can be a complete virtuoso in their field. Sales, marketing, engineering, whatever. I mean, truly the best violinist in the world. But the moment they become CEO, they walk out on stage and someone hands them a completely different instrument, the company's capital. And let me tell you, knowing how to play that instrument is a whole other skill, and it's absolutely crucial.
So here's how we're going to break it all down. First, we'll talk about why allocating capital is the ultimate test for any CEO. Then we'll get into the beautifully simple $1 rule that's at the heart of every single decision at Berkshire. From there, we'll dive into the common and often disastrous mistakes companies make, look at a really fascinating case study from Berkshire's own history, and finally, we'll boil it all down to the key lessons from these two masters.
Okay, let's start with why this is such a big deal. I mean, think about this for a second. The next CEO of Berkshire Hathaway is probably going to have to allocate hundreds of billions of dollars in a single decade. That is more money than has been invested in the company's entire history up to this point. I mean, the stakes just couldn't be any higher.
And this is exactly where that piano analogy hits home. As Buffett says, people usually get to the top job because they are fantastic at something specific. But the minute they're in that corner office, they get handed the checkbook. Now sure, they can listen to investment bankers, they can create fancy strategic planning departments, but at the end of the day, Buffett's right. They better be able to do it themselves. Being great in one area just does not automatically make you great at this one.
So what's the magic ingredient? Well, Buffett calls it having a money mind. And this is so important. It has absolutely nothing to do with having 140 IQ or crazy high test scores. Buffett's seen brilliant people make just boneheaded financial decisions, and on the other hand, he's seen people who might not look as smart on paper who have literally never made a dumb money move in their life. It's a specific kind of wiring, a special temperament that's just essential for this job.
So if you need this money mind, what's its guiding principle? Well, that takes us to the absolute core philosophy that drives every single capital decision at Berkshire. And it's so simple it's almost deceptive, but it is incredibly powerful.
This is it, the $1 rule. Buffett lays it out plain and simple. The only reason for us to keep your money is if it becomes worth more by us keeping it than if we gave it back to you. Think about it. If a company can take $1 of its earnings and, through its investments and operations, reliably turn that into more than $1 of market value for you, the shareholder, then yes, they should absolutely keep that money and put it to work.
And this lays out the choice perfectly. It's such a clear, objective test. If that dollar you keep is only going to be worth, say, 90 cents in market value down the line, well, it's just plain foolish to keep it. The only rational thing to do is to give it back to the shareholders, either through dividends or, as we'll get into, share buybacks. It's just a simple yardstick that cuts right through all the corporate noise.
Now, you'd think this simple logic would just be standard practice everywhere, right? Wrong. As Charlie Munger loves to point out, this is not how they teach corporate finance in the big business schools. They teach all these conventional dividend policies like, we'll just pay out 20% of our earnings every year, which Buffett and Munger think is just plain nuts. So yeah, this simple common sense approach is actually pretty radical.
Okay, so the $1 rule gives us the why, but what about the how? Well, this brings us to the actual tools a CEO can use. Once a company has taken care of its business needs, it's sitting on a pile of extra cash. What should it do? This is the point where that simple logic we just talked about often goes completely off the rails because of human psychology, and it leads to blunders that just destroy enormous amounts of value.
And you've just got to love this analogy from Buffett. It perfectly captures what he calls the institutional imperative, this huge pressure a CEO feels when the company's bank account is just overflowing with cash. There's this urge to just do something with the money, an action bias. And that urge, well, it can lead to some really, really unwise decisions.
So what do these blunders actually look like in the real world? Oh, you've seen them. It's the company that announces a huge share buyback and then just mindlessly buys shares every day no matter what the price is. Or it's the ego-driven merger, what Buffett calls needing to prove our manhood. Or maybe it's just following the herd because all your competitors are doing it. It's all driven by these powerful biases, herd mentality, overconfidence, and this mistaken belief that just being active means you're achieving something. It's when companies value so-called strategic thinking over simple, cold math.
Buffett just slices through all the complexity around share buybacks with this brilliant little thought experiment. Just imagine you and a partner own a business together. If your partner comes to you and offers to sell you their half for 80 cents on the dollar, you'd leap at that deal, right? Of course. But if they offered it to you for $1.20, you'd say, no thanks. Well, it's the exact same logic for a public company. Buying back shares is just buying out some of your partners. You only do it when the price is a bargain. Simple as that.
All right, for a real masterclass in how to actually apply these principles, we don't need to look any further than Berkshire Hathaway itself. It is a fantastic story of how their own thinking about buying back their own stock evolved over decades based on cold, hard logic, not on some rigid and flexible dogma.
So just follow this timeline with me. Back in the 90s, they were pretty hesitant. They basically thought they could always find some other wonderful business to buy at a silly price. But then by 1998, you see Buffett, with total candor, admitting they had probably missed the boat by not buying their own shares back. Fast forward to 2012, and they set a formal rule. We will buy aggressively if the stock drops to 1.1 times its book value. But they weren't stuck on that. Just a few years later, they showed their flexibility, raising that number to 1.2 times book value because the underlying value of their businesses had grown so much. This wasn't driven by emotion. It was a rational, evolving response to value and opportunity.
And at the end of the day, all of this comes down to one central idea, summed up perfectly right here by Charlie Munger. Every single decision is weighed against the next best alternative. Is buying back our own stock at this price a better use of our dollar than buying more Coca-Cola stock? Is it better than buying a whole new business? It is a constant, relentless comparison of opportunities. That's the whole game.
Okay, we have covered a lot of ground, so let's pull all this together and really crystallize the key actionable lessons from the Buffett and Munger playbook. What does it actually mean to build and use a money mind?
You know, Munger puts his finger on a huge problem in the world of finance with this idea of physics envy. People desperately want the messy world of business to behave like the predictable world of physics with these neat formulas that give you a precise answer. They want a spreadsheet that'll just spit out the right number. But as Munger warns, the business world just doesn't work that way, and chasing that kind of false precision is only going to get you in a whole lot of trouble.
And that's really the bottom line here. Great capital allocation is not about running some crazy complex model or following a rigid formula. It's about slowly, deliberately, and patiently improving your judgment. It's about having a rational mindset, deeply understanding the core principles, and then applying them with common sense and discipline over a very, very long time.
So, here it is, the playbook in 4 simple steps. Number 1, master that $1 rule. Always ask, is the dollar we keep in the business creating more than $1 of market value? 2, when it comes to buybacks, use the partnership test. Would you buy out your business partner at this price? 3, ignore what's fashionable. Ignore what everyone else is doing and resist that urge for physics envy. And finally, number 4, the lifelong mission. Cultivate a money mind that is rational, disciplined, and totally focused on simple, powerful ideas.
And that brings us right back to where we started. Whether you're thinking about the companies you invest in, or even just your own financial decisions, it really pays to ask this question. Is the person in charge of allocating the capital a brilliant violinist who's been handed an instrument they don't know how to play? Or do they actually know how to play the piano? Because the answer to that question can make all the difference in the world.
Today, we're going to crack open the playbook for one of the most successful and, let's be honest, one of the most unusual companies on the entire planet, Berkshire Hathaway. But we're not talking about their stock picks. No, we're going deeper. We're going to look at the engine behind the empire, a management philosophy that's so radical, it almost sounds made up. Okay, let's just stop here for a second and really let this sink in. This is Warren Buffett describing a company that's been worth close to $1 trillion. No central HR, no corporate legal team. This isn't just a little quirky. It flies in the face of literally everything modern business schools teach you about how to run a big company. And that really gets us to the core question, right? The Berkshire paradox. How does this corporate giant with hundreds of thousands of employees all over the world operate with a headquarters staff you could probably fit into a large conference room? This is the mystery we're going to unravel today. To solve this thing, we're going to break down the Berkshire engine into 6 key parts. First, we'll really define the paradox. Then we'll look at the absolute foundation, the people they pick. From there, we'll get into how they're managed, or maybe more accurately, how they're not managed. We'll look at their totally unique take on pay, how they handle a crisis, and finally, how it all comes together to create their ultimate competitive advantage. So let's dive in. So first up, let's really get our heads around just how strange Berkshire's structure is. I mean, think about it. It's this massive collection of totally different businesses, insurance, railroads, candy, jewelry, you name it, and they're all operating with almost zero centralized control. So here's the first big piece of the puzzle. Buffett and Munger made a really radical choice. They decided to centralize one thing, and one thing only: capital. All the cash flows up to Omaha, and they decide how to invest it. But that's where it stops. Everything else, hiring, strategy, operations, marketing, is pushed down to the individual businesses, no exceptions. Now, a system like that, well, it can only work if you have a very, very specific type of person running the show. This is the absolute bedrock of their whole philosophy. You just can't have radical decentralization if you don't first have radical trust in your people. And Buffett has been incredibly clear over the years about what he's looking for. It seems simple on the surface. He wants 3 things in a manager: intelligence, energy, and integrity. But, and this is the crucial part, it's not a checklist where 2 out of 3 is okay, because without that last one, the first 2 can become incredibly dangerous. And this just nails the point, doesn't it? It's one of Buffett's most famous lines, and for a very good reason. A smart, energetic person who lacks integrity is the most destructive person you can possibly have in your company. They'll use their smarts and their drive to figure out how to rig the game for themselves. For Buffett and Munger, integrity isn't just some nice-to-have virtue. It's the absolute, non-negotiable firewall that makes their whole system possible. So, you've found these amazing people, intelligent, energetic managers with rock-solid integrity. Now what do you do with them? Well, conventional wisdom says you give them a rule book, you give them quarterly targets, you schedule a bunch of meetings. Berkshire, of course, does the exact opposite. Charlie Munger once described their approach as being a point just short of total abdication. Just think about that phrase. They give their managers almost total freedom. This means no annual budgets being sent up to headquarters, no mandated quarterly reviews. Nobody from Omaha is telling the head of See's Candies what to charge for a box of chocolates. The managers simply run their own ship. Period. This is Buffett's famous baseball analogy, and it's the perfect way to think about it. If you're lucky enough to find a true superstar, a 400 hitter, the last thing you do is send a batting coach to mess with their swing. Berkshire's role is to find the all-stars and then give them the ultimate sign of respect. They just get out of the way. Okay, so this brings up a really fascinating question. A lot of the people who sell their businesses to Berkshire are already rich. They don't need another paycheck. So how do you design a compensation system to motivate people who don't actually need the money? You can always count on Charlie Munger to put it bluntly. He saw most corporate pay plans as systems that just encourage the wrong behavior, like, putting a colony of rats in your grain silo. So, of course, Berkshire threw out that whole conventional playbook. And this table really shows you the difference. The conventional way is complex, it's driven by consultants, and it often ties pay to things a manager can't even control, like the company's overall stock price, what Buffett calls a lottery ticket. The Berkshire way is the total opposite. It's simple, it's logical, and it's custom-made for each business. Pay is based on two things the manager can control: how well their own unit performs and how smart they are with the capital they're given. And here is a key little mechanism that makes it all work. When a Berkshire company needs capital from headquarters for, say, a new factory, they actually get charged for it. There's often a 15% pre-tax hurdle rate. The money isn't free. This one simple rule forces every manager to think like an owner and ask a simple question: is this investment actually worth the cost? It's a brilliant way to stop people from wasting money. And in case you had any lingering doubts about how they feel about the topic, Munger makes it perfectly clear. They see that entire industry of compensation consulting, with all its peer reviews and escalating pay scales, as a system designed to make executives rich for just average performance, not to actually create value for shareholders. So, they want no part of it. So we have this system, and it's built on integrity and this extreme level of autonomy. But of course, people aren't perfect. Mistakes will get made. Problems are going to pop up. How does a system so dependent on trust handle the inevitable bad news? The rule is incredibly simple and incredibly direct. Every single manager knows it. If something goes wrong, you pick up the phone and call Omaha immediately. As Buffett likes to say, problems in business are not like fine wine. They don't get better with age. They fester. They can handle bad news. What they cannot tolerate is finding out about it after it's already blown up. Buffett has studied scandals from Salomon Brothers to Wells Fargo, and he always lands on the same conclusion. The initial problem, whether it's one bad employee or a dumb incentive plan, that's rarely the thing that actually sinks the company. The real crisis, the critical failure point, is step 4, that moment when senior management gets the bad news and they hesitate, or they fail to act on it immediately. That delay is what turns a manageable problem into a total catastrophe for the company's reputation. And this right here, this is the ultimate guardrail. It's a quote that gets sent to Berkshire managers every couple of years. The message could not be more clear. Financial mistakes are forgivable. You can always make more money. But reputation, once you lose it, is almost impossible to get back. It is Berkshire's single most important asset, and they will be absolutely ruthless in defending it. So let's tie all of this together. We've seen how they find the right people, how they give them this radical autonomy, how they pay them rationally, and how they demand honesty when things go sideways. What's the final output of this unique system? What is it all building towards? It's not just about profit margins or return on investment, although it certainly produces those. The whole system is engineered to create something much deeper, something that you can't just copy or even find on a balance sheet. This right here from Charlie Munger is this secret sauce, a seamless web of deserved trust. Notice that word, deserved. It's not a blind trust, it is earned. The managers earn Omaha's trust by acting like owners and protecting that reputation. And Omaha earns the manager's trust by leaving them alone and giving them a permanent home. This culture of mutual, deserved trust is their most powerful and lasting competitive advantage. So I'll leave you with this final thought to chew on. as the corporate world gets buried under ever thicker rule books and more layers of bureaucracy, you have to wonder if maybe Buffett and Munger have been showing us the way out all along. Maybe the ultimate management hack isn't a new piece of software or some complex methodology. Perhaps it's something way simpler and way more human, a seamless web of deserved trust. You know, when you talk about the all-time great business stories, Berkshire Hathaway has to be right there at the top of the list. It's an absolute masterpiece of building wealth and allocating capital. But here's the crazy part that most people don't know. This entire empire, this incredible success story, was built on a foundation that its own creator, Warren Buffett, admits was a complete and utter mistake. Just to give you a sense of the scale we're dealing with, wrap your head around this number. Since Warren Buffett first started buying shares back in 1962, the stock price has gone up 100,000 times. No, that is not a typo. It is a result so absolutely mind-boggling, it almost doesn't seem real. And yet, the whole thing started with a puzzle. And here is that puzzle, straight from the man himself. How in the world does a self-described terrible mistake morph into one of the most successful companies the world has ever seen? Well, the answer isn't some secret formula locked away in a vault. It's a philosophy. It's a way of thinking about business, about people, and about time that is just radically different from pretty much everyone else. So, let's unpack that philosophy, shall we? We're going to start with how that accidental investment became a masterpiece. Then we'll dig into how Berkshire attracts partners, not just shareholders. We'll look at their dead simple yet incredibly powerful acquisition strategy, their radical culture of trust, and finally, how they've built this entire thing to last forever. Okay, so it all kicks off in 1962. Buffett finds this failing textile mill in New England called Berkshire Hathaway. He bought it using a strategy he famously called the cigar butt approach. The idea is you're walking down the street and you find a disgusting, soggy, old cigar on the ground, but it has one free puff left in it. Berkshire was that cigar butt. It was just so cheap, selling for less than its working capital. That little difference in price, that was the free puff. The original plan was super simple. Just wait for the company to buy back its own shares at a slightly higher price and boom, you make a small, quick profit. The CEO, a guy named Seabury Stanton, verbally told Buffett he'd buy his shares for 11 3/8, but when the official written offer showed up in the mail, the price was 11 1/4. That tiny difference, that 1/8 of a point, it just annoyed Buffett so much that out of pure stubbornness, he didn't just sell his shares, he started buying up enough to take control of the entire company. In this moment, right here, reveals the first core lesson. As his legendary partner, Charlie Munger, puts it, the genius wasn't in buying the textile mill. That was a genuinely bad business. The real genius was in recognizing the mistake. Instead of throwing good money after bad, they squeezed every last drop of capital out of that dying textile business and used it to buy better ones. They literally turned a lemon into lemonade. So this idea of doing things completely differently, it extends to how they actually built the company itself. Once they had this public company, they needed shareholders. But Buffett and Munger didn't want just any shareholders. They were obsessed with getting the right kind of owners. And you can just see the difference so clearly here. Most public companies will say and do almost anything to attract investors, right? They chase quarterly earnings, they hype up the stock. Berkshire, they do the exact opposite. They are brutally, refreshingly honest about who they are. They are long-term, no-nonsense owners of businesses. They don't want speculators, they want partners who get that they're buying a piece of a real enterprise. Buffett loves to use this analogy from another great investor, Phil Fisher. Think about it. If you put a big sign out front that says hamburgers, but you only serve fancy French food inside, all you're going to get is a constant stream of disappointed customers. Berkshire advertises exactly what it is, a long-term compounding machine, and that ensures the people who show up are the ones who actually want what's on the menu. It's all about getting the shareholders you deserve. You know, this isn't just a clever business tactic. It's really a life philosophy. Buffett and Munger actively try to filter for people who are on their wavelength. They genuinely believe it's their own fault if someone buys Berkshire stock for the wrong reasons, because that means they sent the wrong signal. And what's the result? Well, it's arguably the most stable and rational shareholder base on the planet. Now, this whole philosophy of clarity and patience, it flows directly into how they go about buying entire businesses. I mean, we live in a world of frantic, nonstop deal-making. Berkshire, on the other hand, is famous for its discipline, for just sitting on its hands and waiting, sometimes for years, for exactly the right opportunity. As Charlie Munger so brilliantly puts it, they just wait for the no-brainers. Most companies have these huge acquisition departments doing what Munger calls endless due diligence baloney, and what happens? 2/3 of those deals turn out to be terrible for the buyer. Berkshire just sidesteps all of that nonsense by waiting for a deal that is so obviously good it just smacks you in the face. So what's their secret, complex criteria? The whole point is that it isn't a secret sauce. It's just these 3 simple steps. First, is it a business they can actually understand? Second, does it have managers they like, trust, and admire? And third, is it being offered at a sensible price? That's it. No complex financial models, no crazy projections, just simple, rational questions. And here is the incredibly powerful result of that simple approach. Imagine you're a founder. You've spent your entire life building a great business. The idea of selling it to a private equity firm that's just going to fire your people and chop it up for parts, it's disgusting. It's revolting. So Berkshire becomes the only logical buyer for people who actually care about their company's legacy. They offer a permanent, trusted home. So they buy these great businesses run by great managers, and then what do? Well, this is where the Berkshire way gets even more radical. The whole thing is built on a culture of almost absolute trust and decentralization. And this quote right here, it gets to the very heart of their entire management philosophy. Most parent companies think their job is to meddle, to find synergies, to optimize everything. Buffett believes his most important contribution is to just get out of the way. They buy great managers for a reason, so they can let those managers keep running their businesses without somebody from corporate breathing down their necks. So what does this hands-off approach actually look like? Well, get this. Berkshire famously has no corporate strategic plan, no mission statement. They've never hired a management consultant. There are no endless budget meetings. In fact, for a company worth hundreds and hundreds of billions of dollars, there are only about a dozen people working at headquarters. This isn't laziness. It's the ultimate system built on trust. But, all of this raises the biggest question of all. This entire system seems to revolve around 2 brilliant, folksy guys from Omaha. So what happens when they're no longer around? How does an institution like this possibly survive beyond its iconic founders?
Buffett, of course, answers this with his typical dark humor, but his point is incredibly serious. With almost all of their own money tied up in Berkshire stock, they are personally and financially obsessed with making sure this company thrives long after they're gone. Succession isn't some item on a checklist, it's a constant obsession. And you see, when it comes down to it, succession at Berkshire isn't about finding another Warren Buffett. That's impossible. It's about institutionalizing the culture he built. The number one job of the next CEO and the board is to be a guardian of that culture. They believe it's so strong now that any weird foreign behavior, like focusing on quarterly profits or building up a bureaucracy, would be immediately rejected like a foreign tissue. And this, right here, is the ultimate vision. Berkshire isn't just a vehicle for its managers to get rich and then sail off into the sunset. It is designed to be a permanent institution. There is no finish line. The goal is to create a company that will be a secure and prosperous home for its businesses and its shareholders 100 years from now. So when you bring all of these different pieces together, turning a huge mistake into a huge opportunity, attracting partners instead of speculators, waiting patiently for the no-brainers, and building a culture of absolute trust, you really start to see the answer to that puzzle we started with. But if you had to boil the entire Berkshire Hathaway way down to a single core idea, it would be this simple, powerful piece of advice from Charlie Munger. The real secret isn't some static formula you can copy. It's a mindset. It's a commitment to continuous learning, to adapting, to seeing reality for what it is and having the guts to change course. That right there is how a terrible mistake in a little textile mill became a global masterpiece. Which really leaves us with a final thought, doesn't it? Our modern world, it's completely obsessed with speed, with disruption, with move fast and break things. So what can we learn from an empire built on these timeless, almost old-fashioned principles of patience, trust, and thinking for the very, very long term? What's the real value of building something for forever? Let's be honest, when you think about the insurance business, the word boring probably comes to mind, maybe necessary evil. But for Berkshire Hathaway, it's something else entirely. It's the engine. It is the secret weapon that built one of the greatest corporate empires the world has ever seen. But, as we're about to find out, this weapon is a double-edged sword, forged in a very, very dangerous fire. That's a quote from Warren Buffett, and just think about that for a second. With a pen,
One signature on the wrong piece of paper, one bad promise, and you can unleash decades of financial ruin. This isn't just a theory. In Buffett's own hometown, the insurance giant Mutual of Omaha managed to wipe out half of its net worth, which took decades to build, in the blink of an eye, all because they handed the pen to the wrong person. So that's the big question, isn't it? How on earth did Berkshire Hathaway not just survive in this incredibly treacherous world, but actually master it? How did they turn the industry's single greatest risk into their most powerful, most enduring advantage? Well, that's what we're here to unpack. All right, so first up, a dangerous game. To really get Berkshire's genius, you have to appreciate just how perilous this industry truly is. This quote really gets to the heart of what's called long-tail risk. See, when an insurer writes a policy, the real costs might not show up for years or even decades. The mistakes you make today are basically landmines you're planting for your future self. Buffett tells this incredible story about a policy written back in the 1950s for just a few $1,000s. Decades later, it ended up costing the company $1.5 billion. The surprises, as he says, are rarely good ones. And you can see the trop. On the surface, what could possibly be better? Cash comes flooding in the door today, and all you have to do is give someone a little piece of paper, a promise. It feels like you're printing money. And this is the siren's call that has lured countless companies onto the rocks. Which brings us to Section 2, the siren's call of cash. Because this temptation, this allure of getting that immediate money, it creates this brutal, competitive world where discipline is always the first thing to go out the window. What a great image, right? Brokers swimming with their fins showing. What he means is, if you're willing to offer a foolishly low price, if you're willing to do the dumb thing, you will get all the business. Everyone will rush to you. See, competitors get desperate for that upfront cash, so they underprice their risk again and again. Why? Because the cash comes in now, and the devastating losses, well, those show up later, usually on someone else's watch. And look, this isn't just an abstract concept. Buffett provides a truly stunning real-world example from inside one of his own companies, GEICO, that shows you exactly how this plays out. So picture this. It's the early 1980s. GEICO writes a few specialized policies and collects about $70,000 in premiums. 70 grand. At the time, they figured it was easy money, that they were just picking cherries. Seemed like a great deal, right? Well, no. Decades later, the claims from those exact same policies were finally all tallied up. The final result? A loss of $93 million, all from that initial $70,000. That is the terrifying power of the pen when you chase cash today without thinking about the real risks of tomorrow. So, okay, the business is clearly a minefield, but this is where the whole story pivots. This is where Berkshire figured out how to harness the very structure of the industry, that delay between getting the cash and paying the claims, and turn it into this incredible source of power they called float. So what on earth is float? Let's break it down simply. It's the giant pool of premium money that customers pay you up front. Now, this money doesn't technically belong to you. It belongs to your policyholders. You're just holding on to it until claims eventually need to be paid. But in the meantime, and this could be for many, many years, you get to invest all of it for your own profit. And here is the magic trick. For almost every other insurer out there, this float comes at a really high price because their actual business of selling policies, their underwriting, loses money. So in effect, they're paying a high interest rate for this giant loan. But Berkshire, through just relentless iron-willed discipline, consistently manages to make an underwriting profit. Think about that. The premiums they collect are more than enough to cover claims and expenses. They are literally getting paid to hold and invest billions of dollars of other people's money. It's not just free, it's better than free. And the scale of this is it's hard to even wrap your head around. Let's just walk through this. In 1967, Berkshire had $17 million in float. Not bad. By 1996, that jumped to $7 billion. Fast forward to 2012, $70 billion. And as of last year, a mind-boggling $165 billion. This isn't just a side hustle. This is a colossal self-funding investment machine right at the very heart of the entire company. And of course, Charlie Munger, as always, puts it perfectly. He says there are people who would kill for such opportunities. And he's not exaggerating. This isn't just a good business practice, it's an advantage so profound, so valuable, that it is the absolute envy of the entire financial world. So, how did they do it? How did they pull this off when almost nobody else could? Well, it was no accident. It was a philosophy, a set of ironclad rules that ran completely counter to what everyone else in the industry was doing. This is what we're calling playing the Berkshire way. I mean, just look at the contrast in thinking here. It's night and day. While the rest of the industry is chasing volume, Berkshire obsesses over profitability. While others price their policies based on what happened last year, Berkshire prices based on long-term probabilities. The industry desperately wants smooth, predictable earnings every year. Berkshire is totally fine with lumpy, uneven results as long as they know they're making smart bets. And here's the absolute killer. Most companies set sales targets, volume budgets. At Berkshire, that's forbidden. They have zero volume goals. And this quote right here explains exactly how they enforce that discipline. Think about it. If your job depends on hitting a sales number, what are you going to do? You're going to write some dumb business just to keep the machine running. By removing that fear, by guaranteeing no one gets laid off for a drop in volume, Buffett ensures his team's only pressure is to write profitable business. If the prices aren't right, they are literally encouraged to sit on their hands and do nothing. Almost no other company in the world operates that way. Okay, let's bring it all home. Section 5, an unbeatable edge. Because when you put all of these pieces together, the massive, cost-free float and that radical discipline, what you get is a fortress with a competitive edge that is just about unbeatable. And it's not just one advantage, it's a whole system of interlocking strengths. They have more capital than anyone, so they can take on risks no one else can even dream of. That capital gives them incredible investment flexibility. Their reputation is like Fort Knox. Everyone knows they'll pay their claims, which attracts the best kinds of business. They've got legendary management in people like Ajit Jain. And maybe the most important piece, they have massive earnings coming in from their railroads, their energy businesses. That means they can absorb a catastrophic insurance loss that would literally bankrupt any of their competitors. So what this all adds up to is something fundamentally different. See, Berkshire isn't just a better insurance company. Its whole corporate structure allows it to be the ideal insurance company. It's the one entity that can actually afford to hold enough capital to survive a true worst-case scenario. Because for them, that capital isn't just sitting there. It's out there powering an entire empire. And in the end, it really comes down to this simple, brutal truth from Charlie Munger. The insurance industry itself is not some golden ticket. It's a minefield. The secret weapon isn't the business itself. It's Berkshire's absolute total mastery of the business. Which leaves us with a final thought to chew on. Berkshire took this famously difficult, supposedly boring industry and found this hidden source of immense power right inside its core structure. So the question for you is, what other seemingly mundane businesses are out there, hiding their own secret weapons, just waiting for someone to come along and figure out how to play the game just a little bit differently? Welcome to The Explainer. Today, we're going to crack open the minds of Warren Buffett and Charlie Munger, two of the all-time greats, to really understand how they look at accounting. And for them, it's not just a bunch of numbers on a page. No, they see it as the true language of business, and maybe more importantly, as a direct reflection of a company's character. So here's our roadmap. First, we'll get into why they think accounting is really all about character. Then, we'll look at a wild, historic fight they led against what they called corrupt accounting. After that, we'll break down the critical red flags they always look for. Then, we'll see how they do it themselves, their philosophy for honest books at Berkshire Hathaway. And finally, we'll connect all the dots and see how this approach actually helps them build a better company by attracting better partners. All right, let's dive right in. The absolute cornerstone of the Buffett and Munger philosophy is this: a company's financial statements are way more than just a dry set of figures. They believe they are a direct window into the morality, the ethics, the very soul of the people running the show. And this quote right here, it completely reframes why you should even bother reading a financial report. See, it's not just some technical exercise to figure out the earnings per share. It's really a behavioral analysis. You have to ask yourself, are these managers genuinely trying to tell me the economic truth of their business? Or are they trying to paint a prettier picture, one that kind of hides what's really going on? This is the core belief. Buffett argues that the smartest way to allocate money in an economy, what he calls intelligent capital formation, can only happen if you have accurate, honest accounting. Because if the accounting is bad, it completely warps reality. Money flows to the wrong places, and the whole system just suffers. Now, this isn't just some abstract theory they talk about, right? These principles were really put to the test back in the late 90s and early 2000s. There was this huge, nasty fight over how companies should account for stock options, a battle that, as Munger would later say, dishonor won. So, to show you just how ridiculous the arguments were against expensing stock options, Buffett dug up this brilliant story from history. I mean, it sounds totally made up, but he says it's a perfect parallel to what corporate America was trying to pull with accounting rules. He said the huge corporate lobbying effort was just like an actual bill that was once introduced in the Indiana legislature. It literally tried to pass a law that would make pi equal to a new, simpler, and completely wrong number. The goal wasn't to find the truth, it was just about convenience. And with stock options, the goal was to hide a massive, massive expense. And here is the absolute kicker. You had all these companies arguing, with a straight face, that stock options were not a form of compensation, so they shouldn't be an expense. But as Buffett points out, every single person who got them knew darn well they were a valuable part of their pay. It was an obvious economic fact that they just wanted to pretend didn't exist in their accounting. You know, this is the part that truly disgusted Buffett. It wasn't just a few bad apples fudging the numbers. This was a coordinated, systematic attack by corporate America to pressure the Accounting Standards Board, the FASB, into officially signing off on a lie. They wanted to make cheating the new standard. And Munger, well, you can always count on him to cut right to the chase. His take on how it all turned out? Corruption won. For a long, long time, the lobbyists got what they wanted. For accounting purposes, the value of pi was basically changed to 3. And he saw that as a deep, deep stain on American capitalism. So going through that whole mess, and other situations like it taught Buffett and Munger to be incredibly skeptical. And it helped him develop a really simple but powerful set of rules for spotting companies that are playing games with their numbers. These are warning signs that any of us can use. They boil it all down to 2 major red flags, 2 things that should make any investor stop and think twice. First, accounting that seems deliberately confusing, and second, this obsessive focus on managing or smoothing out the quarterly earnings numbers. Their first rule is just beautiful in its simplicity. If you're reading a company's annual report and you can't figure out how they make money, or the footnotes are written in some kind of dense gobbledygook, just walk away. It's not your job to be Sherlock Holmes. That confusion you're feeling, that's the signal. Honest managers want you to understand their business. And the second red flag is this obsession with hitting a specific earnings number every single quarter. Buffett compares this game of earnings management, tweaking assumptions here and there to make the numbers look nice and smooth. He compares it to a dangerous drug addiction. It feels good in the short term, but it always, always catches up with you, and usually in a very bad way. And then there's Munger. Of course, he takes it even further. He believes that the pressure coming down from corporate headquarters to deliver these perfectly smooth, always growing earnings reports is the root of so much corporate evil. He sees it as a moral cancer that pushes otherwise decent people to do really bad things. Okay, so we've seen all the problems they've called out in the corporate world. So now let's flip it around and see what the solution looks like. How do they actually handle the books at Berkshire Hathaway? Their whole philosophy is built on being deeply, almost radically conservative. In a world where every other company is trying to make things look as good as possible, Munger asks this great question. What is wrong with a world where everything is a little bit underreported? They think being too optimistic in your accounting makes you do stupid business decisions because you start to believe your own hype. Being conservative keeps your feet planted firmly in reality. Here's a perfect practical example of how they think. When they buy a company, they make this really important distinction. They judge the CEO of the company they just bought based on the return they get on the tangible assets, the stuff they can actually control. But they judge themselves on the return they get on the total price they paid, including that premium or goodwill. So, one number is for judging the business, and the other is for judging their own skill as investors. It's brilliant. At the end of the day, it's all about what's really happening with the money. When they're looking at buying a business, they don't give a hoot about the accounting gymnastics or how it's going to make their reported earnings look next quarter. All they care about are the real economics of the deal. And that, they say, frees them up to make much smarter decisions. And finally, we get to what I think is one of the most brilliant parts of their entire strategy. We see how all these principles, honesty, clarity, focusing on the long term, it's all part of a bigger plan to attract a very specific and much better kind of shareholder. Think about it. Everything they do, from the way they write their plain English annual reports to their famous refusal for decades to split their crazy high-priced stock, it's all one big filter. They're trying to pull in people who think like they're going to own the business forever, and they are actively trying to push away the speculators who are just looking to make a quick buck. And hey, this isn't just talk. The numbers totally back it up. Get this. A study in Business Week found that Berkshire's annual shareholder turnover was only 3%. Just 3%. To put that in perspective, for most other big companies, that number is way, way up in the double digits. Their shareholders aren't just trading in and out. They're staying put, like real partners. Now, they have a name for this that's, well, it's a bit controversial. They call it their eugenics program for shareholders. But what they mean is it's a self-selection process. By being so clear, so honest, and so focused on the long term, they attract a shareholder base that is completely in sync with them. And they believe that gives them a massive advantage, making the whole company stronger and way more stable. So, after all this, what's the big takeaway for you and me? It all boils down to one simple but really profound question that we should be asking about our own investments. When you look at the companies you own, what language are they speaking? Is it the clear, honest language of business designed to tell you what's really going on? Or is it the complicated language of confusion designed to manage your expectations and just play with numbers? Because as Buffett and Munger have shown us, the answer to that question tells you everything you need to know about the character of the people you've trusted with your money. Have you ever just sat back and wondered how some investors, they seem to consistently make these brilliant decisions, while somehow dodging all the big mistakes? Well, a huge piece of that puzzle lies in a really simple but incredibly powerful mental model from two of the greats, Warren Buffett and Charlie Munger. It's called the circle of competence, and honestly, getting a handle on this can totally change how you look at not just investing, but pretty much any big decision you have to make. So let's dive in. We're kicking things off with this zinger from Charlie Munger because it just nails the entire concept in one sentence. You see, the circle of competence isn't about puffing out your chest and listing off everything you know. Not at all. It's about having the humility, the self-awareness to draw a very clear line around what you don't know. And as we're about to see, knowing exactly where that edge is, well, that's the most critical skill of all. All right, so here's the game plan for this explainer. First, we're going to define what this circle of competence thing actually is. Then we'll get a visual with their classic castle and moat analogy. It's a good one. After that, we'll get into their pretty controversial take on change and why they often see it as a threat. Then we'll look at the tool they use to stay disciplined, the chew hard pile. And finally, we'll get to the really human part of the story, how even these masters have learned, evolved, and admitted to some massive misses. Okay, let's jump into part one and build the foundation, the circle itself. The big idea here, and the subtitle says it all, is that this has nothing to do with being a genius. It's really all about intellectual honesty. It's about the discipline of knowing the exact boundaries between what you truly, deeply understand and everything else. So here's the basic definition. Just picture a circle on a piece of paper. Inside that circle, that's your turf. Those are the businesses, the industries that you genuinely get. You know how they make money, you know who their competition is, you have a pretty good idea what they're going to look like in 10 years. And everything else, all the complicated, fast-moving, shiny new things, that all lives outside the circle. And here's Buffett with a brutally simple way to test this. Notice there's no maybe, no gray area. If you're having an internal debate trying to convince yourself that you understand something, you don't. It's got to be an immediate, confident yes. Otherwise, it's a hard no. This one little rule is an incredible defense against getting sucked into the latest hype or following the herd into some area you just don't fully get. You see, and this is so important, this is not an ego competition. Buffett is the first to admit his circle is actually pretty small, but he always says, you know what? It's big enough. You don't get bonus points for pretending to be an expert in biotech and software and energy trading. You get paid for making really good decisions on the handful of things you actually truly understand. That's it. That's the whole game. And this just brilliantly gets to the heart of it. Munger's wit makes a point you'll never forget, right? Think about it. In every other important part of our lives, we seek out specialists. We want the expert. So why on earth should investing or business be any different? The idea is to find your niche, find your area, and stick to it. Okay, so let's say you found a business that's squarely inside your circle. Now what? How do you figure out if it's actually any good? This brings us to their most famous analogy, the one you've probably heard of, the castle and the moat. This is how they visualize a truly fantastic investment. Buffett lays it out perfectly here. The terrific economic castle, that's the business itself. Its brand, its profits, its staying power. But here's the thing. In a capitalist economy, every great castle is constantly under attack from competitors. So the most important part is the wide and long-lasting moat. That's the company's durable competitive advantage. It's the thing that keeps all the invaders at bay. So what does a moat actually look like in the real world? Well, it can be a few things. It could be being the company that can make things cheaper than anyone else, like a Costco. It could be a powerful brand that just lives inside our heads, like Coca-Cola. Or maybe it's a tech advantage, or just being so massive that you have economies of scale nobody can touch, or a distribution network that's impossible to replicate. These are the defenses that let that castle just keep getting richer year after year. And this quote just wraps up their whole philosophy. Look, investing is not the Olympics. You don't get extra points for difficulty. The reward for a simple, obvious good idea is exactly the same as the reward for a super complex one. So why would you try to be a hero? Just find the one-foot hurdles, the businesses with obvious wide moats that you can understand without a PhD, and just step over them. Okay, now we're going to get into what might be the most counterintuitive, almost backwards-sounding part of their whole approach. While pretty much the entire world is chasing innovation and disruption, Buffett and Munger, they look at massive change and they mostly see a threat. And this slide really breaks down that huge difference in mindset. Wall Street absolutely loves change. It creates stories, it creates trading, it creates excitement. But for Buffett and Munger, rapid change is the sworn enemy of long-term certainty. It makes the future way harder to figure out. So instead of trying to predict the next big thing, they look for businesses so durable, so stable, that they're probably going to be doing almost the exact same thing in 10 or 20 years. They are actively looking for boring. And here you go. These are the real-world examples. People have been chewing Wrigley's gum and drinking Coca-Cola for more than a century. The basic products, fundamentally the same. Buffett has this great line where he says he doesn't see a whole lot of technology disrupting the art of the chew. And it's that kind of predictability that gives them the confidence to put billions of dollars down for the long haul. And this is a perfect illustration of why they're so careful about change. Just look at these moats that used to seem invincible. Downtown department stores. They had a monopoly because that's where all the transportation went. Then, boom, the car and the shopping center come along, and that moat is filled in. Or newspapers. For decades, they were the ultimate local monopoly on information and ads. Then the internet arrives, and poof, that incredible moat just vanished. See, even the strongest castles can fall when the landscape shifts. So, if your whole strategy is to avoid chaos and stick to what you know, how do you actually do that? Well, that brings us to our next section, the too hard pile. This isn't just a concept, it's a practical tool for discipline. They have this really simple 3-box system for every idea that comes across their desk. You've got the in-box. These are businesses they get and the price is right. Then you've got the out-box. Great businesses they understand, but they're just too expensive right now. And then there's the third and biggest box, the too hard pile. This is where most stuff goes. And it's not a criticism of the business. It's just an honest admission. We don't have an edge here. We don't get it. And the key to this whole thing is how ruthlessly they use it. Can you imagine the pressure in the late 90s during the dot-com bubble? Everybody was getting rich on tech stocks, and Buffett and Munger were being called dinosaurs, relics, for sitting on the sidelines. But they just calmly took company after company, telecom, software, you name it, and tossed them right into the too hard pile. Emotionally, that had to be tough, but intellectually, for them, it was simple. It was outside the circle, period. But the story doesn't stop there. And this last part is maybe the most important lesson of all. Because for all their discipline, these guys are also incredibly humble. They're willing to learn, willing to evolve, and they are not afraid to admit when they've made a mistake. Just listen to this. This is a jaw-dropping admission from Charlie Munger. They watched Google from day one. In fact, their own company, GEICO, was a huge early customer, paying Google $10 every time someone clicked an ad. They saw the business model's power firsthand. They knew the founders, and they still passed. Munger flat out calls it a failure. That's incredible honesty. And believe me, Google was not the only one. Munger has said that missing Walmart was a total cinch that they just whiffed on. Buffett admits he watched Jeff Bezos build Amazon from the beginning, thought he was a genius, and still completely underestimated what he could do. Their willingness to talk openly about their biggest mistakes is in itself a masterclass. Which of course brings us to the billion-dollar question. After decades of tossing tech stocks in the too hard pile, after admitting they missed Google and Amazon, why in the world did Berkshire Hathaway end up making Apple its biggest investment by a country mile? What gives? And the answer is just a brilliant bit of mental jujitsu. See, Buffett didn't suddenly become a tech expert. He didn't expand his circle. No, he realized he could understand Apple by looking at it from inside his existing circle. He stopped thinking of it as a tech company where you have to guess the next gadget. Instead, he started seeing it for what it was, a consumer products company with an unbelievable brand and customer loyalty. He wasn't analyzing the microchips, he was analyzing human behavior. And that was a subject he understood perfectly. And really, that's what it all comes down to. The big lesson from Buffett and Munger isn't that you have to be the smartest person out there. It's that you have to be the most honest person about what you know and what you don't. Their staggering success wasn't built on having a giant circle of competence. It was built on knowing exactly where the perimeter was and having the discipline to never, ever step outside of it. So the question I'll leave you with is this: what's inside your circle? And are you being honest enough with yourself to stay there? You know, if you've ever felt that pit in your stomach watching the stock market ticker just bleed red, you get it. The single biggest challenge in investing, it's not about picking the right company. It's about managing your own emotions. All that constant noise, the prices, the news, it can feel almost impossible to stay calm and rational. But what if there was a way to think about it, a mental model that could completely reframe how you see all that daily chaos? Well, let's dive in. This sentence right here from the great Charlie Munger is the key. It unlocks one of the most successful investment philosophies ever created. It's really the core idea behind a story, an allegory that Warren Buffett first learned from his mentor, the legendary Benjamin Graham. It's a way of thinking that can take market volatility from being a source of pure anxiety and turn it into a source of incredible opportunity. So here's the plan for this explainer. We're going to walk through this whole mental model step by step. We'll start with the classic problem that every single investor runs into. Then I'm going to introduce you to the star of our show, Mr. Market. After that, we'll get into the rules for how to deal with him. We'll touch on a big academic debate, and we'll see why your emotional stability is way more important than your IQ. And we'll wrap it all up with a lesson that's crucial for a lifetime of learning. Okay, so let's start with the big problem, the very thing that makes the stock market so appealing. You know, the fact that you can buy or sell a piece of a business any day you want. That's also what makes it so psychologically dangerous. When you're watching prices bounce around every single second, it becomes incredibly hard to keep that long-term business owner mindset. And this really gets at a fascinating paradox, doesn't it? The ease of trading, the constant access to prices, it all feels like a huge advantage. But what it does is tempt us, constantly, to forget Benjamin Graham's most important rule. We stop thinking like we're buying a stake in a real business, you know, like a farm down the road or a local apartment building, and we start treating stocks like they're just little lottery tickets wiggling around on a screen. And that, right there, is the trap. So how do you escape that trap? Well, Graham and later Buffett and Munger, they came up with this powerful story. They basically reframed the entire stock market into one single, unforgettable character. So it's time for you to meet your new business partner. Okay, so imagine this. You own a piece of a fantastic private business, and your only partner is this guy named Mr. Market. Now, he's a very helpful partner in one way. Every single day, without fail, he shows up at your door and he names a price. And at that price, he's willing to do one of two things, either sell you his half of the business or buy your half from you. But this partner has a very, let's just say, a peculiar personality. And this is Buffett's brilliant, colorful way of putting it. See, Mr. Market isn't some rational analyst. He's a manic depressive. Some days, he's absolutely euphoric. He only sees a bright, rosy future, and he'll offer you ridiculously high prices for your shares. But on other days, he is just deeply pessimistic, totally convinced the world is ending, and he'll offer to sell you his shares for pennies on the dollar. He is, in a word, emotional. So here's the most important point of all. Mr. Market's mood swings, they're his problem, not yours. He exists for one reason, to present you with opportunities, to serve you. He is absolutely not there to give you advice or to tell you what your business is actually worth. His daily prices are just his emotional state put on display. You and only you get to decide if his mood has created a bargain for you. Okay, so if the market is this emotional character, how do you actually deal with him to your advantage? Well, this brings us to the practical rules of the game. The very first rule is a complete shift in your mindset. You have to stop seeing stocks as tickers and start seeing them for what they really are, a fractional ownership of a real, live, operating business. This is the foundation. And honestly, if you don't truly believe this deep down, none of the other rules are going to matter. This slide just lays out the entire process perfectly. Step 1 is your homework. You have to come up with your own idea of what a business is worth, and that valuation has to be totally separate from its stock price. Step 2 is easy. You just listen to what Mr. Market is offering today. Now, step 3, that's where the magic happens. If his price is crazy low compared to your valuation, maybe you buy. If it's absurdly high, maybe you sell. But the most powerful step of all, that's number 4. If his price is anything other than silly, you do absolutely nothing. You just ignore him, close the door, and get on with your day. I mean, think about that for a second. In almost any other competitive field, sports, business, you name it, you have to be constantly active. You got to swing at every pitch. But in investing, you don't. You can just stand there and wait for that perfect, slow, fat pitch right down the middle. The biggest mistake an investor can make is to let Mr. Market's frantic energy get to them, to feel like they have to do something every day. The second you start acting like the emotional one, you've lost your single greatest advantage. Now, this whole idea of an emotional Mr. Market, it seems to fly right in the face of a pretty famous academic theory, right? The efficient market hypothesis. That theory basically says that prices are always right because they reflect all the available information. So, what do Buffett and Munger have to say about that? Well, what's so interesting is that Buffett doesn't just dismiss the whole idea out of hand. He actually concedes that, yeah, most of the time, the market does a pretty decent job. It's not easy to find obviously mispriced companies. He'll say the market is roughly or fairly efficient. But it's in that little gap between fairly efficient and perfectly efficient where all the opportunity lies. And here's the powerful pivot. Believing in the hard-form version of that theory, the idea that prices are always perfect, is, in Buffett's view, a catastrophic mistake. It just closes your mind to the very opportunities that Mr. Market's emotional fits create. He says that if you had adopted that belief 30 years ago, it would have been like learning the earth is flat. It's a neat and tidy theory that is just fundamentally wrong. Charlie Munger, as he always does, has an even sharper analogy for why these elegant but wrong ideas stick around in academia. He talks about a famous doctor who kept using an outdated surgical method. And why? Because it was a wonderful operation to teach. It was easy to demonstrate to students. It gave the feeling of doing something important, even though a much better method existed. And that's the punchline. All these complex financial formulas based on perfect market efficiency, well, they're easy to grade on a test. They feel rigorous and scientific. But according to Munger, they completely fail the test of reality. Why? Because they ignore the psychotic drunk in the room, Mr. Market. And because of that, in the end, they're just balderdash. So, if it's not about complex formulas and having a sky-high IQ, what is the key to success? Well, this brings us to what might be the single most important quality an investor can have, and it's not something they teach you in finance class. Just let that number sink in for a minute. Berkshire Hathaway, one of the greatest wealth creation machines in modern history, has seen its stock price literally cut in half on 3 separate occasions. Buffett will tell you there was nothing fundamentally wrong with the business when this was happening. It was just Mr. Market having one of his deep, dark depressions. And if you can't emotionally handle that kind of volatility, even with a business you believe in, you're probably in the wrong game. And this is really the last word on the subject from Buffett. It is not about being the smartest person in the room. It's about having the right psychological makeup. Fear and greed are incredibly powerful forces, and they cause people to do the exact opposite of what they should. They get scared when everyone else is scared, so they sell when Mr. Market is panicking. And they get greedy when everyone else is greedy, so they buy when he's euphoric. Controlling that impulse, that is the entire game. Look, understanding Mr. Market is a huge, huge step, but the learning doesn't just stop there. The world is always changing, and if you want to be a successful investor, you have to be willing to change right along with it. Right here, Munger is reminding us that even the absolute best strategies have a shelf life. Ben Graham's original method, finding companies trading for less than the cash they had in the bank, That eventually stopped working because those kinds of opportunities just dried up. Buffett and Munger had to adapt. They evolved to buying wonderful companies at fair prices instead of just fair companies at wonderful prices. And I think we can leave it with one of Munger's most unforgettable and, frankly, hilarious images. The cost of standing still intellectually is just brutal. You have to be willing to destroy your own best-loved ideas. The world of business and markets, it's a dynamic, competitive place, and standing still is an absolute recipe for disaster. So as you look at the markets from now on, the ultimate question isn't what's the market going to do next? The real question is, how am I going to react? The story of Mr. Market teaches us that the biggest risks and the biggest opportunities, they're not out there on the ticker tape. They're right inside our own heads. The real challenge is mastering ourselves. Is your temperament the tool you use to take advantage of Mr. Market, or is it the weakness that allows him to take advantage of you?
You know, when you think about two of the world's most successful investors, Warren Buffett and Charlie Munger, what comes to mind? You'd probably assume they have some crystal ball, right? That they're incredible macro forecasters, predicting every little turn in the market. But the truth is, it's something way more surprising and honestly, a lot more useful for the rest of us. Their real secret isn't about predicting the future, it's about knowing what to ignore.
And this one idea from Charlie Munger, it's really the key to their entire philosophy. They're not trying to predict the economic weather, no. Instead, they pour all their energy into finding businesses that are just so strong, so well built, that they can survive and even thrive in whatever storm comes their way.
So that leads to the big question, right? In a world where we are absolutely drowning in financial news and expert predictions and economic data, how can these two giants of investing just say, nah, we tune it all out? I mean, it seems impossible. It almost sounds reckless. But as we're about to see, it's the very foundation of their incredible success.
Okay, so let's get into it. Here's what we're going to cover in this explainer. First, we'll look at the paradox that sits at the very heart of modern investing. Then we'll dig into how Buffett and Munger actually tune out all that noise. After that, what they focus on instead. We'll also tackle how they think about massive forces like inflation. And then finally, we'll reveal the one and only one macro bet that they are more than willing to make.
All right, first up, the investor's paradox. To really get what makes Buffett and Munger so different, you first have to understand the world they've made a conscious choice to ignore.
For most of us, this is what investing feels like, doesn't it? It's just a relentless storm of information. Every single day, there's a new forecast, a new crisis somewhere in the world, a new piece of data telling you to buy or sell, or let's be honest, just to panic. And the assumption baked into all of this is that you have to pay attention to it just to stay afloat.
And then you get this, a total 180-degree rejection of that whole game. Buffett says it so plainly. Not only are their market opinions worthless, he thinks they could actually do harm. They could interfere with their real work, which is figuring out good businesses. And this is the exact spot where their path just completely splits off from Wall Street. So, okay, if they're not listening to all the market chatter, what in the world are they doing? Well, this leads us to their first really powerful technique, a deliberate, almost willful agnosticism toward all that market noise.
You know, Buffett loves to point back to his own history. He bought his very first stock in 1942. Now think about that for a second. The outlook for the Allies in World War II was, well, it was bleak. And just look at the headlines since then. The Cold War, the constant threat of nuclear war, presidents resigning, runaway inflation, tech bubbles bursting, global financial meltdowns. If you'd waited for the macroeconomy to look perfectly clear and safe, you'd still be sitting on the sidelines 80 years later with cash under your mattress.
And this is where they just flip the whole script on what a market downturn means. Most people see prices falling and they think, danger, risk, get out. Buffett sees the exact same thing and thinks, sale, it's on sale. He says, look, if you're going to be buying groceries for the rest of your life, you get excited when prices go down. So why on earth should buying little pieces of wonderful businesses be any different? A market panic is just a chance to buy something you love at a much better price.
And this slide, man, it just lays it all out, doesn't it? It highlights the total mental shift. On one side, you've got conventional wisdom, which is obsessed with forecasts, tries to time everything, and is terrified of downturns. But the Buffett and Munger way is practically the mirror image. They focus on business value, they ignore predictions, and they actually welcome the chance to buy things cheaper. They believe timing the market is a fool's game, but valuing a business, that's a puzzle you can actually solve.
But that raises a pretty obvious question, right? If they're spending zero time trying to predict the market, What are they spending all their time thinking about? Well, that brings us right to our third section, focusing on the business itself. It all comes down to this incredibly simple but really profound little filter they use. Everything they look at has to pass through this two-part gate. First, is it important? And second, is it knowable? If the answer to either one of those is no, they just move on. Simple as that. So here's the key. It's how they actually define these words. Sure, the direction of the global economy is definitely important. Of course it is. But in their view, it is simply not knowable. No one can predict it consistently. So what's left? What is both important and knowable? For them, it's the long-term competitive position and earning power of a specific business that you can truly, deeply understand. And Coca-Cola is their go-to example for this. Just imagine buying one share of Coke for $40 when it went public way back in 1919. Now, if you somehow had perfect foresight of the century ahead, the Great Depression, World War II, the Cold War, the constant threat of nuclear Armageddon, you would have found 1,000 reasons to sell or to never even buy it in the first place. But the one important and knowable thing was that a simple, desired product was going to make people happy billions of times a day all around the globe. And that single focus is what turned $40 into over $5 million. Okay, so this brings us back to that little puzzle we mentioned earlier. If they truly ignore macroeconomics, why do we always hear them talking about huge economic forces like interest rates and inflation? It seems like a contradiction.
And here's the answer. It's brilliant. They don't use these forces like tea leaves to predict the future. They use them as fundamental laws of physics to value businesses today, in the present. And this analogy of interest rates being like gravity is one of Buffett's most powerful ideas.
Just think about it like this. When gravity is really strong, meaning when interest rates are high, it takes a whole lot more force for anything to get off the ground. The value of every other asset, stocks, real estate, you name it, gets pulled down because the risk-free return you can get from just sitting in a government bond is so attractive. But when gravity is weak, when interest rates are near zero, asset values can float up to incredible heights. See? It's a valuation tool for right now, not a crystal ball for tomorrow.
And they look at inflation the same way. It's not about reacting to the latest monthly report from the government. No, they see inflation as a fundamental, long-term enemy of the investor. Buffett once called it a giant corporate tapeworm that silently eats away at your real returns even when your statements look like they're going up. It's a killer.
So what's the game plan against this long-term enemy? Well, their answer is actually super practical, and it starts with you. The number one best protection is your own earning power. If you are the absolute best doctor or plumber or software engineer in your town, you will always command your fair share of society's resources, no matter what a dollar is worth. The second best protection? Owning a piece of a truly wonderful business, one that can raise its prices right along with inflation without having to spend a ton more money just to stay in the same place.
All right, so after all this talk about ignoring the big picture, you might be surprised to find out there is one, just one, macro force they are absolutely willing to bet the farm on. This is their one big exception.
Remember that Munger quote from the start about swimming in the currents? Well, here he's talking about the tide. And for them, that tide is the relentless, forward-moving power of the American economic system.
Their unwavering optimism isn't some kind of blind faith. It's a bet on a system that, for over 200 years, has consistently rewarded innovation and productivity. It's this idea that capitalism's engine of creative destruction just keeps finding ways to get more out of every person, which ultimately raises living standards for everyone. And this powerful tide, they believe, is what will lift the best businesses, the strong swimmers, over the long run, no matter how choppy the water gets in the short term.
And this quote right here just brings it all together perfectly. Trying to figure out when the market will go up or down is a hopeless task. It's impossible. But figuring out what will happen, that great businesses will keep creating value, that people are still going to drink Coke and use American Express cards, that the overall tide of human ingenuity will keep rising, that, in their view, is not so difficult at all.
Which, leaves us with this final thought for today. We live in an age of constant updates, breaking news alerts, and endless analysis. It's a fire hose of information pointed right at our faces. But maybe, just maybe, the real wisdom from Buffett and Munger isn't about knowing more than everyone else. Maybe the most valuable skill of all is having the discipline to ignore almost everything.
It's funny. You'd think the biggest lessons in business would come from, I don't know, Wall Street or some fancy MBA program. But sometimes they come from the most unexpected places, like a candy shop.
Today we're going to dig into how this one small, family-owned company out in California basically gave Warren Buffett and Charlie Munger an education that turned out to be worth hundreds of billions of dollars. It's an amazing story.
And I mean, get a load of this quote from Charlie Munger. It's just not what you'd expect to hear about one of the best investments ever, right? We were pretty damn stupid. Wow. That right there tells you that the story of See's Candies isn't about two geniuses just spotting some obvious gold mine. No, not at all. It's about two incredibly brilliant investors who were this close to making a massive mistake, and how learning from that near miss, well, it changed absolutely everything for them.
So that's the big question, isn't it? How on earth did this one candy shop become the actual blueprint for the future of Berkshire Hathaway? How did it teach them the exact lessons that would later lead them to make these massive, iconic investments like Coca-Cola? Well, the answer, that's where you find the real secret behind their incredible, legendary success.
All right, so here's how we're going to break it all down. First, we'll look at the pivotal candy purchase itself. Then, the power of a brand. After that, unlocking true pricing power. Then we'll talk about fishing in the right pond. And finally, we'll get to the real secret, what Munger called ignorance removal.
All right, let's dive in. So, picture this. The year is 1972. Warren Buffett and Charlie Munger are looking at buying this candy company. It's called See's. It's well-liked, sure, but it's mostly just a regional thing. Now, you gotta remember, at this point in their careers, they're total disciples of Ben Graham. Their whole game is about buying businesses for less than they're worth on paper, what they famously called cigar butts.
Okay, so here are the numbers. The deal, it looked pretty good, but here's the catch. It was not one of their classic cigar butt deals, not even close. The sellers wanted $25 million for a company that only had $9 million in actual, physical, tangible assets. You know, buildings, equipment, stuff you can touch. That meant they were being asked to pay a huge premium for, well, for something they couldn't even see on a balance sheet. And for them, that was way, way outside their comfort zone.
And this part is just wild. It shows you how stuck they were in their old way of thinking. They were so rigid, so focused on the numbers, that they were literally ready to walk away from what would become one of the greatest businesses they'd ever own, over $100,000, a measly $100,000. Munger himself admitted it. He said, that's how dumb we were at that time. They were, in his words, just barely smart enough to actually go through with it.
So, pulling the trigger on that deal? It ended up kicking off this massive evolution in how they thought about investing. Maybe the most important one ever. It forced them, really forced them, to finally understand the huge invisible power of a truly great brand.
And you can see the before and after right here, clear as day. They went from the old Ben Graham way, buy fair businesses at a wonderful price, to their new, now famous mantra, buy wonderful businesses at a fair price. See's was the teacher. It taught them that the quality of the business itself, its brand, its reputation, the space it holds in a customer's heart, was just so much more important than getting some kind of statistically cheap deal.
And listen to this. This is the real kicker, and it comes straight from Buffett himself. The lessons they learned from this $25 million candy company back in '72, that's what gave them the mental model, the confidence to go out and make a $1.3 billion bet on Coca-Cola 16 years later. Think about that. Without See's, that legendary Coke investment, one of the absolute cornerstones of Berkshire Hathaway, it might never have happened. So what exactly did they learn? They learned about the power of something called share of mind. It's this incredible asset that you will never, ever see on a balance sheet. It's just the simple fact that when someone on the West Coast wanted to give a gift, a box of chocolates, the first name that popped into their head was See's. Just like when people all over the world think soft drink, they think Coke. Buffett said you could hand him $30 billion and tell him to take on Coke, and he wouldn't even know where to start. How do you dislodge that from billions of minds?
So, the big takeaway here is incredibly powerful. A real, lasting competitive advantage, what they call a moat, it's not just about having the biggest factories or the most patents. It's about building a fortress right inside the minds of your customers. And that was the first billion-dollar lesson they got from that little candy shop.
Okay, so this realization led them straight into another huge lesson. This one was basically a masterclass in economics, all about pricing power and inflation. See's was the perfect case study. It showed them exactly what a truly great business looks like, financially speaking.
And I absolutely love this quote from Buffett, because you can just feel it, can't you?
He's saying the real acid test for any business, the ultimate sign of strength, is whether you can raise your prices without your customers running for the hills. A weak business? Well, they have to hold a prayer session, as he puts it, before raising prices even a penny. But a business like C's, with that brand loyalty, they could raise prices year after year just to keep pace with inflation, and guess what? Customers didn't even blink. They just kept coming back for more.
And this discovery led them to piece together the perfect business model, the kind of thing you really want to own, especially when inflation is running high. So here's the recipe. First, you need that strong brand we just talked about. Second, that brand gives you the power to raise prices. Third, and this is crucial, the business doesn't need tons of new money pumped into it to grow. You put all that together, and owning a business like that is like collecting a royalty check that just gets bigger and bigger all on its own. And the results for C's? I mean, they're just staggering. Look at this. They started with a business that needed only about $9 million in tangible assets. Over the decades that followed, they only had to put in about another $30 million. So for that tiny total investment, the business has spit out over, wait for it, $2 billion in pre-tax earnings, cash that Berkshire then turned around and used to buy other great companies. That, my friends, is the absolute definition of capital efficiency.
Okay, so this leads right into their next huge realization. And this one is all about how you pick your battles, how you select which businesses to even get involved with. After they felt the pure joy of owning a fantastic business like C's, it really highlighted a painful but super valuable lesson about their past mistakes. And Charlie Munger has this fishing analogy that is just, it's so simple, but it's absolute genius. He says the first rule of fishing is to fish where the fish are. And the second rule? Never forget the first rule. It doesn't matter if you're the world's greatest fisherman. If you're in a pond with no fish, you're going home empty-handed. Your success depends more on the pond than on your skill.
And believe me, they learned this lesson the hard way. Before they bought C's, they'd owned all kinds of just awful businesses. These were the tough ponds. A department store in Baltimore that was going nowhere, a windmill business, an agricultural pump manufacturer. Buffett said you could pour all your energy and brilliance into these things, and it just didn't matter. They were fishing in a desert.
But then you contrast that with the rich ponds. Businesses like C's Candies, like Coca-Cola, these places were just teeming with fish. The built-in quality of the business itself meant that any effort they put in was magnified, and it led to these unbelievable results. The lesson? It is so much better to be in an easy, wonderful business than it is to try and be a hero in a terrible one.
So the really critical lesson from all those early mistakes was this: stop trying to fix businesses that are fundamentally broken. They learned that old saying is true: you really can't make a silk purse out of a sow's ear. And after, as Munger so eloquently puts it, getting their nose rubbed in that reality a few times, they finally decided to stop looking for sow's ears altogether and just go looking for silk.
Okay, so let's bring this all home. What's the big overarching secret that this whole C's Candies experience really tells us about Berkshire Hathaway's success? I'll tell you what it's not. It's not about just being born a genius. It's about something way, way more powerful than that.
I mean, first off, just look at the raw numbers, the tangible result of their education. That first $25 million purchase has now generated over $2 billion in earnings. That cash was the seed money for so many other investments. But here's the thing, that financial return, as mind-boggling as it is, that's not even the most valuable part of this story.
No, the real secret is right here. Munger has this incredible phrase for it. He said the biggest contribution of C's Candies was ignorance removal. He's totally convinced that if they hadn't kept learning, if they had just stuck with what they knew at the beginning, Berkshire would be, well, it would be basically nothing today. The engine of their success wasn't their starting line brilliance. It was their relentless, non-stop, unending commitment to getting just a little bit less stupid every single day.
And that really leaves us with one last thing to think about. Buffett and Munger came so close to missing out on the single investment that completely redefined their careers. It was a close call, a near miss, and it forced them to learn, to adapt, to evolve. So it kind of makes you ask yourself, doesn't it? What's the most valuable lesson that a mistake or maybe even a near miss has ever taught you? All right, so when I say Warren Buffett's greatest investments, what pops into your head? Probably Coca-Cola, maybe American Express or Apple. But, you know, one of his absolute earliest and most defining successes was an insurance company with a talking gecko. This is the story of GEICO. And it's not just about how it became a crown jewel for Berkshire Hathaway, it's about how it found itself in a fight for its life against a rival that was playing a totally different game. So let's dive in, because this story has some twists you might not see coming. You heard it from the man himself.
Buffett thinks the entire auto insurance business pretty much turns conventional wisdom on its head. And honestly, the story of GEICO is the perfect case study for that. It's a story about brilliant simplicity, but also about a massive, massive blind spot and the brutal pressure that comes with innovation. This quote right here really sets the stage for what we're about to unpack.
You know, Buffett's love affair with GEICO started incredibly early. I mean, get this. Way back in 1951, he's just a 20-year-old kid, still a student. He takes a trip to D.C. on a Saturday, finds the GEICO office, and literally bangs on the door till a janitor lets him in. He ends up in a 4-hour one-on-one meeting with the company's future CEO, and he was so completely blown away that he went out and put 65% of his entire net worth into the stock. Think about that conviction. It wasn't just another investment. It was an all-in, bet-the-farm moment that really did define his entire career.
So, what did this 20-year-old kid see that so many others missed? What made this one company so incredibly special? Well, his partner, the legendary Charlie Munger, has a term for businesses like this. He calls them a lollapalooza. It's when you have all these different powerful forces that combine and just reinforce each other, creating this incredible, unstoppable outcome. So let's break down exactly what made GEICO a true lollapalooza.
The secret sauce? It was just brilliantly simple. GEICO sold insurance directly to people. That's it. They cut out the whole expensive network of agents that all the other big guys relied on. In Buffett's own words, it was a low-cost method of distribution that was almost impossible for the old guard to copy. I mean, how could they? Their entire business was built on those agents. This wasn't just a small edge, it was the entire foundation of the company.
And this low-cost model, it created this powerful self-reinforcing feedback loop. It's beautiful when you see it. Your costs are low, right? So you can offer lower prices. Those lower prices naturally bring in a flood of new customers. And as you get more and more customers, your scale gets bigger, which, guess what, drives your costs down even more. It's a virtuous circle that just spins faster and faster.
Let's really dig in on this low-cost idea, because you have to understand, in the world of auto insurance, being the low-cost provider isn't just an advantage, it is the ultimate weapon. Understanding why is pretty much the key to this whole story. Just think about your own life. Nobody wakes up in the morning excited to buy car insurance. You don't want to buy it, you have to buy it. It's a mandatory purchase. And for most families, it's a real line item in the budget. So when you're forced to buy something you don't really enjoy, what's the number one thing you're looking for? The lowest price. Period. GEICO got that fundamental human truth better than anyone.
And boy, did they make sure everybody knew it. After Berkshire took full ownership in '95, they didn't just step on the gas, they floored it. The ad budget went from a pretty modest $20 million to a mind-boggling $800 million by 2009. The goal was simple. Just hammer and hammer and hammer home that message of savings until GEICO became synonymous with a good deal.
And what's amazing is that Buffett saw the endgame playing out way ahead of time. As early as 2004, he knew that this direct-to-consumer model was the future, and he saw that there was really only one other company playing the same game at a high level, Progressive. He basically predicted that the whole industry was going to boil down to a two-horse race, a slugfest between GEICO and Progressive. And you know what? He was dead right.
But here's where the story takes a turn. Because when you have a moat that wide, when you're that dominant, you can start to feel invincible. But history is just littered with the graves of giants who got toppled by some disruptive little upstart. And the real irony here is that the blueprint for how to disrupt GEICO came from a company that did the exact same thing a generation earlier.
It really is the essential question, isn't it? If you're running a successful company, you have to constantly be asking yourself, where is the next attack coming from? And for GEICO, the crazy thing is, the answer was staring them right in the face, hidden in the history of their own industry.
Okay, so picture this. It's the early 20th century. The insurance industry is run by these absolute titans like Aetna and Travelers. They have all the money, these massive networks of agents. They are the market. Then along comes State Farm in 1922. A little mutual company with no capital, no agents. They looked like a gnat buzzing around a herd of elephants. But they found a better, cheaper way to serve their customers, and they grew to become the biggest auto insurer in the country, leaving all those old giants in the dust. It proves a timeless lesson. In insurance, a better model always beats being the big guy.
This is classic Charlie Munger. The rise of State Farm was one of those extreme examples. It should have been a permanent warning sign flashing for every other insurer out there. It proved, beyond a shadow of a doubt, that a better business model could crush any advantage. GEICO had been the disruptor for decades, but now it was about to find out what it felt like to be the one getting disrupted.
So let's turn to the modern challenger. While GEICO was busy perfecting its low-cost machine and blanketing the airwaves with clever ads, its old rival Progressive was quietly building a completely new kind of weapon. One that wasn't based on cost at all, it was based on data.
You know, one of the most fascinating ways to watch this whole story unfold is to just track Warren Buffett's own public comments over the years. You can literally see his thinking evolve in real time. It starts with him just confidently dismissing this new technology, which slowly turns into respect and then finally into a crystal clear acknowledgement that they have a serious problem. Let's watch it happen.
Okay, let's wind the clock back to 2012. Buffett gets asked about this new thing Progressive is trying out, called telematics, putting devices in cars to track how people actually drive. And his response, as you can see, was a total shrug. He called it an experiment, said he didn't see it threatening GEICO in any way. Looking back now, that was a critical blind spot.
Now let's fast forward just 9 years to 2021. And the tone, it's like night and day. Here, Buffett is openly admitting that Progressive just built a better mousetrap, that they were better at the absolute core of insurance, matching the rate to the risk. For the leader of a company that prides itself on being the best, this is a stunning admission.
So what happens when a giant finally realizes it's falling behind? I mean, acknowledging the problem, that's step one. But step two, actually catching up, that's a monumental task. Especially when your main competitor has a decade-long, maybe even longer head start on you.
At the Berkshire meeting in 2019, their insurance czar, Ajit Jain, laid out the problem with brutal honesty. He said, look, GEICO is still way more efficient. Our expense ratio is 7 points better. That's our low-cost moat. But Progressive's data is so good, their loss ratio, how much they pay in claims, is a massive 12 points better. You do the math. Progressive's underwriting was a full 5 points more profitable. GEICO's famous low-cost moat was getting flooded by Progressive's ocean of data.
And 3 years later, Jane was even more direct. He just came right out and said it. The biggest culprit is telematics. Progressive has been doing this for more than 10 years, while GEICO, until recently, just wasn't involved. That isn't just a small misstep. That's a fundamental failure to see a paradigm shift happening in your own industry.
And the challenge of catching up was made 1,000 times harder by this massive technology mess they had internally. As Ajit Jain explained, GEICO was dealing with over 600 old legacy computer systems, a patchwork of tech from different decades that couldn't talk to each other. Their goal is to get all of that down to just 16 modern systems. I mean, can you imagine trying to build a cutting-edge data operation when your own tech is a tangled disaster? It's a monumental and incredibly expensive problem to fix. Okay, so let's bring this all home. The story of GEICO, its incredible rise, and its more recent struggles, it really offers a powerful, timeless lesson for anyone who's interested in business or investing. And what's really cool is how it connects right back to the very origins of value investing itself.
Now here's the beautiful irony in all this. Benjamin Graham, the guy who literally wrote the book on value investing, was famous for buying cheap, ugly cigar butt companies. But, as Charlie Munger loves to point out, the single best investment of his entire life, the one that made him the most money, was a fantastic growth company, GEICO. It just proves that finding one truly great business can be way more powerful than finding 1,000 mediocre bargains.
So in the end, the GEICO story is a really powerful, cautionary tale. It shows us that no competitive advantage, no matter how wide or how deep it seems, is permanent. A moat isn't something you just build once and then admire. You have to constantly be reinforcing it against the tides of technology and change. GEICO's low-cost model was an act of pure genius, but their failure to embrace data early on created a huge vulnerability. And it leaves all of us with a really important question to think about. What's the telematics of today? What's the subtle technological shift that's happening right now that might just be eroding the moats of the seemingly untouchable giants of our own time?
When you hear the names Warren Buffett and Charlie Munger, the first word that probably pops into your head is genius, right? We picture them having these incredible, almost magical insights that nobody else can see. But what if that's not the secret at all? What if their entire massive success is built on something way simpler, but also way more powerful? Not chasing brilliance, but just systematically, ruthlessly avoiding stupidity. Today, we're going to break down that core philosophy. It's a masterclass in how to win by simply refusing to lose.
And this quote from Charlie Munger, it's pretty much their entire playbook in one sentence. Think about it. It's not about celebrating your wins and patting each other on the back. It's about a rigorous, almost obsessive, deep dive into your mistakes. Most companies, and hey, most of us, we want to talk about what went right. Buffett and Munger are convinced the real advantage, the real learning, comes from studying your errors, from rubbing your own nose in them, so you just become incapable of making that same dumb mistake again.
All right, so here's the game plan. First, we're going to start with their foundational rule, what they call the art of not dumb. Then we'll look at the specific weapons they've been warning us all about for decades. From there, we'll get into how they tell the difference between a truly great business and a truly terrible one. After that, we'll tackle the psychological side of things, the investor's mindset. And we'll wrap it all up with a single, really provocative thought that ties this whole philosophy together.
Okay, let's dive into the absolute cornerstone of their entire philosophy. It's an idea that's so simple, it almost sounds, well, a little silly. But in practice, it is incredibly powerful and honestly, super rare. This is the art of just not being dumb.
There it is. This is the whole thing. Their incredible decades-long track record isn't built on some complex algorithm or predicting the next big thing. Nope. It's built on avoiding catastrophic mistakes. It's a game of subtraction, not addition. They believe most people get into huge trouble not because they missed some brilliant opportunity, but because they make an obviously bad call, a decision that when you look back was just ungodly dumb. Their first question for any decision is simply, what are all the ways this could kill us?
And listen, this isn't just some abstract idea. It's exactly how Buffett got his start. He wasn't sitting around waiting for a stroke of genius. He was doing the hard, grinding, boring work. I mean, he literally went through over 20,000 pages of financial manuals, page by page, twice. He was hunting for what he called cigar butts, these tiny, forgotten companies that were just so ridiculously cheap. They were not dumb investments by definition, because you were paying so little it was almost impossible to lose money. It's a foundation built on pure grunt work, not genius.
So if that's how they avoid dumb decisions with individual stocks, how does that idea scale up? Well, they take that exact same logic and apply it to what they see as the biggest source of potential stupidity in the entire financial world, derivatives. Buffett famously called them financial weapons of mass destruction, and trust me, he's been yelling about them for a very, very long time.
So what's their beef with derivatives? For Buffett, it all comes down to a really terrifying mix: ignorance and borrowed money. He says that even though they're often sold as these sophisticated tools to reduce risk, what they really do, especially when they get crazy complicated, is create and concentrate risk on a scale that is just terrifying. As Munger likes to say, you start off selling soap, and the next thing you know, you're writing puts on bonds, and you've entered a completely different and way more dangerous world.
And look, this is not them being Monday morning quarterbacks. Check out this timeline. As early as 1994, Buffett was warning about this stuff. In 2003, that's a full 5 years before the 2008 financial crisis, he was on the record saying they could cause a systemic problem. He pointed out how they basically made a joke out of the rules put in place after the 1929 crash. And even as recently as 2016, his opinion hadn't changed one bit. It's still a time bomb waiting to go off. That level of consistency is just staggering.
So let's break down exactly why they're so dangerous. First, the leverage is just off the charts. I mean, it makes the 1920s look tame. Second, the accounting, as Munger puts it, is irrationally optimistic. Traders get paid these massive bonuses today for deals that might blow up 10 years from now. This also concentrates a huge amount of risk in just a handful of big, interconnected banks. So if one of them gets in trouble, they could take everybody else down with them. At the end of the day, they see it as a recipe for a complete systemic meltdown.
Okay, so we've covered what to run away from in the financial markets. But what do you run towards? What do you actually look for in a business? This is where their thinking gets really, really clear. They basically split the entire business world into two buckets: wonderful franchises and absolutely terrible commodities. And for them, winning is all about knowing which is which.
And that really gets us to the big question, right? The question every single investor has to figure out. When you look at an entire industry, what are the fundamental things that make it a place where money goes to grow and multiply versus a place where capital just goes to die?
This table just lays it out perfectly. On one side, you've got a franchise, like an American Express. It has a brand that's so powerful it gives them real pricing power. Munger tells this great story where Amex actually jacked up the fee on its Platinum card right in the middle of a competitive fight, and their customer retention actually went up. That's a franchise. Then you've got the other side of the coin, a commodity business, like airlines. The competition is, in their own words, suicidal. There's no brand loyalty, you just buy the cheapest ticket, right? They have zero power to set prices, and they have to constantly spend billions on new planes just to stay in the game. And the result? 100 years of bankruptcies. Now, this quote about the movie business is so sharp because it's not just about competition, it's about incentives and egos. In Hollywood, they argue, the goal for a lot of executives isn't necessarily to make money for the shareholders. It's to be a big shot, right? To get invited to the cool parties, to have a hit movie attached to your name. And they can use shareholder money, other people's money, to buy that personal status. That kind of misalignment is a massive red flag.
This might be their most famous and, yeah, most brutal takedown of an industry ever. It's funny, but it is dead serious. The airline industry has burned more investor cash over the last century than almost anything else. It's just a perfect storm. Insane capital needs, cutthroat competition, powerful unions, and huge sensitivity to fuel costs. It's the textbook example of a business that's great for customers, cheap flights, but just absolutely awful for the people who own it.
And this is such a brilliant point because it shows that even a great franchise can die. For decades, owning the only local newspaper in town was one of the best businesses on the planet, a true monopoly. Advertisers had nowhere else to go. But then, the internet happened, and suddenly those advertisers had tons of other, better ways to reach people. The newspaper's essential nature was gone, and just like Buffett says, their ability to set prices just poof, evaporated. A great business turned into a terrible one.
All right, so let's say you get it. You know how to spot the landmines in the market. You know what a great business looks like. But according to Buffett and Munger, the final, and by far the hardest challenge, isn't out there in the market. It's right between your own two ears. It's all about winning the inner game.
This slide really lays out the two different universes they operate in. You've got academic finance on one side, with its elegant models that assume everyone is rational and markets are perfectly efficient. Then you have Buffett and Munger, who look at the real world and see a circus driven by pure, raw fear and greed. The academics build models where a massive crash is a Six Sigma event, something that should only happen once every few thousand years. Buffett and Munger, on the other hand, worry about blow-ups constantly because they know human psychology makes them way more common than the models predict.
And this really gets to the heart of their critique. That false sense of precision you get from a complex financial model can be incredibly dangerous. It makes you feel like you're in control, like you understand all the risks, but it's a total illusion. If you need a supercomputer and a spreadsheet to figure out if something is a good investment, it's probably not a good investment. In Buffett's view, a truly great opportunity should scream at you from a simple, back-of-the-envelope calculation.
This is maybe the perfect metaphor for their entire philosophy on risk. You can have a strategy that makes money day after day. It works 99% of the time. But if that 1% of the time you go completely broke, it's a stupid strategy. Playing Russian roulette works 5 out of 6 times, right? But no sane person would ever play it. The lesson for them is dead simple. Some risks are just not worth taking. Period. It doesn't matter how good the upside looks or how tiny the probability of ruin seems.
And that's what it all boils down to. That 1 in 6 chance, or a 1 in 100, or 1 in 1,000. If the outcome is catastrophic, permanent loss, what they call ruin, then the probability doesn't matter. The only acceptable probability for total ruin is 0. Everything they do, every decision they make, is designed to avoid any situation where that bullet might be in the chamber.
So this brings us to our final thought, and it's the one that really pulls everything we've talked about together. Avoiding dumb mistakes, understanding leverage, mastering your own mind. It's all perfectly captured in the story of long-term capital management, a hedge fund run by actual Nobel Prize winners that famously, spectacularly, blew up the entire financial system back in 1998.
It sounds so simple, doesn't it? But it's just incredibly profound. The guys who ran long-term capital management, they were already fabulously wealthy. I mean, they had everything they could ever want or need. And yet, they leveraged themselves up to the eyeballs, risking everything they had to make more money that they didn't need at all. The point is, once you've already won the game, you have to change the way you think about risk.
And that's the question we're going to end on. This is the ultimate ungodly dumb mistake. It's about risking what you have and what you need for something you don't have and don't need. Buffett sees this as the central, tragic flaw in so many financial disasters, all driven by ego and envy. And really, it's a question that goes way beyond investing, doesn't it? It's a question for all of us about how we think about risk, about success, and about what's actually important in our own lives.